With the First Word News, I'm Ritika Gupta. The Biden administration is poised to impose sanctions on Russia. Russian individuals and entities would be punished for alleged misconduct, including efforts to disrupt the U.S. presidential election. The moves could be announced today. In a phone call with Vladimir Putin, President Biden warned that the U.S. would defend its interests. Fed Chair Jerome Powell says the central bank will probably scale back its bond purchases before considering whether to raise interest rates. In a virtual event in Washington, Powell sketched out the Fed's exit strategy. He said rates are unlikely to be raised before 2022. U.S. health regulators have extended the pause on the use of the Johnson & Johnson's coronavirus vaccine. They concluded their meeting without a vote on the issue. Now they'll seek more data on a rare clotting side effect. That pause could cast doubt about the shot that's helping vaccinate rural communities and other hard-to-reach populations. JP Morgan is launching a multi-trillion-dollar green initiative. The bank has set a goal to finance $2.5 trillion in projects that combat climate change and advance sustainable development over the next 10 years. It will include $1 trillion of financing for projects that bolster cleaner energy sources. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know that racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy and we need companies to step up.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
From New York City for our audience worldwide, this is Bloomberg Surveillance alongside Tom Keene, Lisa Abramowitz. I'm Jonathan Ferro, counting you down to the opening bell and a retail sales print in America. Here's the price action for you. Whipping through things, starting with the S&P 500, up by 18, 19 points on the S&P. We advanced by 4 or 0.5%. A bounce back in the NASDAQ too. Yesterday was a struggle for the NASDAQ 100. We're up now by about 0.6% there. Yields come in going into retail sales. We're down 2 basis points on a 10-year to 161.30. And euro dollar just off 120. Euro dollar 119.75. Citi earnings out a little bit later this morning after a Bank of America beat a little bit earlier this morning as well. Tom Keene, we've got to talk about retail sales a little bit more. This boom, I just wonder how well appreciated it is now at the moment in America.
Oh, we're going to see it. I mean, the data's going to come in, and we've started like 3, 4, 5 items of data. Imagine where we're going to be, John, in a couple weeks as we look at the consumption data.
Lisa, the numbers get better and better, and I've been looking at the consensus estimates on the Bloomberg ECFC, and that has just been inching higher over the last several months, and it now has a 6 handle for GDP in 2021.
But you said the question, and this really is the key conundrum in markets: how long can it last? If it runs really hot, does that indicate a shorter boom, or does that indicate a hotter recovery that is longer? And really, this is unclear. I was speaking with an economist this week about how much precedent there is to this. There really isn't. There are tax rebates that people spend right away and then save the rest of it, but they really don't have any way of measuring long-term spending of such a big pile of savings.
The shape of this cycle, Morgan Stanley really doing some nice work on this, I think, in the last month or so, Tom. The shape of this cycle, as Lisa points out, will it be shorter? Will it be hotter as well? Will it be different to what we saw in the previous 10 years?
I mean, what was it, 2 months ago, we had Morgan Stanley talking about shorter, and I'm beginning to see, including Diamond at JP Morgan, extend out to a longer cycle as well. John, I do want to note BlackRock out with their earnings. We're not going to dive into it, but it's stellar, and what I really notice is the concept of total BlackRock, and underestimated there, John, is their retail exposure. It's booming.
Oh, Tom, that business has been booming for a long, long time. Yeah. And it keeps booming. The inflows have just been phenomenal. I caught up with Bank of America earlier this week, Tom. They said the equity inflows in the last 5 months have been greater than the equity inflows for the whole of the last 12 years.
Yeah.
That was a stat from Bank of America. Can you get your head around that?
No, you can't. You can't. Really well. That's the most important thing I've heard since we started, John. You can't get your head around this. We are in a boom. There's shadows of 1947, 48, but they're just shadows. Let's do this, John. Let's go over to geopolitics right now and quickly. Jack Fitzpatrick with this Bloomberg sanctions reporter. Jack, there's 7 topics to talk about, but there's only one front and center right now. It goes down to a single headline that the Kremlin suggests they will not back off from the eastern border of Ukraine, even with the sanctions we may see today. Tell us about the linkage of sanctions to the tensions in Ukraine.
Well, actually, more of the justification we've heard for this new round of sanctions has been focused on SolarWinds, the SolarWinds hack, and past election interference. So I can't necessarily say that this would be the last shoe to drop, obviously, over what we're seeing currently with the troop buildup of Russian troops near Ukraine. Probably more to watch on that front, but at least we see the Biden administration moving forward on sanctions that are being cast as sort of addressing old wrongs that they see from Russia, rather than a current up-to-date maneuver in response to the troop movement.
Jack, is this a worsening of relations between Russia and the U.S., or is this sort of an ongoing back and forth tit for tat that people were expecting from the Biden administration?
Russia says it's a worsening of relations. It does look like the Biden administration is kind of trying to thread the needle. I mean, a month or so, maybe 2 months ago, Biden brushed off Putin when Putin asked for a conversation. Then you had a phone call the other day that popped up seemingly out of nowhere. So they are trying to keep the line of communication open. I'm sure there will be a tit for tat. Russia has said they'll respond to these sanctions. But it doesn't seem like something where the Biden administration is trying to really massively shake things up.
Jack, just sticking with script, at least the script that has been the case for the Biden administration since the beginning of the year. Infrastructure, we heard from Republicans some idea of some sort of skinny infrastructure bill. How realistic is an $800 billion skinny infrastructure bill?
Yeah, we've heard from a couple Senate Republicans, let's focus on something that's more traditional physical infrastructure that they said would probably come out to about $800 billion. That hasn't developed enough so that we could count up 60 votes of support. It seems like the kind of thing that would probably lose a lot of Democratic support because they do want to cut a lot of Democratic priorities. That's why $800 billion is barely more than a third of what Biden proposed, $2.25 trillion. So that's not a very well-cooked idea just yet.
Jack, I want to talk about Moscow and Afghanistan. I want to link the sanctions debate today with the reality that we're leaving Afghanistan, not only the U.S., but NATO troops as well. I want you to link Moscow and Afghanistan together. A 9-year Russian conflict, a 20-year U.S. effort as well. Do you and the think tanks in Washington just presume that Russia, China, and India, they'll fill the vacuum if we leave?
That is generally a concern, or at least rather the concern is who's going to fill the vacuum. Russian activity, Russian presence in the Middle East is sort of this overarching concern lately, especially when you talk about Iran. A lot of the conversations recently about Afghanistan specifically have been what this means for the final talks with the Taliban. But yeah, after everything we've seen with the U.S.'s policy toward the Middle East, the big question in Washington is what does this do in terms of a power vacuum there? And that's maybe a little bit of an unanswerable question right now, but you're essentially getting on the big question in Washington in response to this.
Jack, it's good to catch up, sir. As always, Jack Fitzpatrick of Bloomberg Government. Tom, I was listening to a talk with the former Foreign Secretary in the UK, Mr. David Miliband, with Queen's College, Cambridge yesterday, and he reminded me of a saying out of the Taliban over the last decade that I think is worth hearing again today. They see it as the Americans have the watches and we have the time. And that is true over the last 10 years, last 20 years, and that'll be true for the next 22.
I remember, John, sitting on our floor in London, and the United Kingdom was bringing back some coffins from Afghanistan, and very much different than the United States, where the coffins slip into this nation quietly. The UK followed the coffin all the way back through Germany and on to the United Kingdom. It was a radically different approach to what we've seen over these decades in the United Kingdom versus America.
Yeah, Tom, I think we've all got friends, family who have served in Afghanistan. My brother-in-law did several tours over there, and it has always felt like we'd never get out. And I think some people still feel that way, even though we have a date right now, Tom, September 11th of this year.
What I would emphasize, John, and I'm speaking completely as an amateur, is the underestimation in America is the linkage of the 2,500 troops of the United States with some 8,000 troops of NATO. This is a NATO pullout. I read the NATO statement this morning, I believe from Brussels, and, you know, NATO is pulling out of Afghanistan.
Coming up on the program, we'll catch up with Congressman Andy Barr, the Republican from Kentucky, from New York City this morning. Good morning to you all. It's a busy one. City coming up a little bit later, retail sales a little bit later after that. From New York City, this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
City for our audience worldwide. This is Bloomberg Surveillance, and here's the price action this Thursday morning. Good morning to you all. Equity futures advanced 19 points on the S&P 500, up nicely by about 0.5%. Similar move on a Russell. On the Nasdaq, on a Russell, up by almost 1 full percentage point. A nice lift to this market going into a really important retail sales print with expectations sky high. Switch up the board and get to the banks. Let's take a look at Wall Street just quickly. Earnings from Goldman Sachs yesterday, absolutely stellar. Flying, red hot, and fantastic execution from the team at Goldman as well. That raises the bar for Morgan Stanley coming out tomorrow. Bank of America early this morning. If we can get some price action, there it is, up by about 1.5% off the back of better than expected earnings at $40.50. That's where that stock trades right now. But let's finish on this. Going to do the KBW Banks Index, Tom. I wonder why.
Wonder why.
Year to date, up by 26.34% year to date. It has had a great year so far. The 10-year yield up 70 basis points, in line with that story. But we've been talking about this. We had a hot CPI print a little bit earlier this week, a little bit hotter than expected, and yields went the other way, lower. Have we seen a peak of this story? I think that's the question we've been asking repeatedly, and we've got to keep talking about it. 161.30 on 10s. We saw 174 at the back end of March, and then we stalled out. And I wonder what that means for this bank rally too, Tom.
Well, we're going to have to see on the bank rally this morning against Citigroup at 8 o'clock. Conversation with Brian Moynihan coming up later as well. Right now, my conversation of the day on banking with Thomas Michaud. Thomas Michaud, Chief Executive Officer of Keefe, Bruyette and Woods, a Stifel company, and we're thrilled that Mr. Michaud could join us this morning because he knows you walk into a banker's office and you start to talk about consolidation. Tom, you guys invented it back in 1962 at R.L. Day and all that, Tucker Anthony, R.L. Day, and the merger into KBW. You guys literally invented the modern consolidation with the Bank of New England. Are we going to see a redux in this bank boom of consolidation?
Well, Tom, that's a great memory. You do remember a long way back. We did work on those deals for Bank of New England. But so the industry's been consolidating for many decades. And the question is, what's the pace? But consolidation's an important theme here, and we think it is going to continue. And we think it's going to continue for a couple of primary reasons. Number one is, it seems as if for the first time, at least in my 35-year career, the bigger banks are more profitable. You look at our earnings models for next year, we see them earning about 200 basis points more return on tangible common equity. And it feels like it's going to be consistent. It's not just a flash in the pan. So scale seems to be working. That's number one. Number two is we're in a really slow revenue growth environment. And one way to grow earnings is costs out. And then the third reason is we thought fintech was important pre-COVID. What we've learned during COVID, it's even more important than we thought. All the trends that we were seeing were accelerated by the pandemic, and that's going to drive even more need for investment. And you're going to see more consolidation.
That's right. I knew you were going there. I want to go, folks, into some inside baseball here, and we do this on Global Wall Street. What is the profitability, Thomas showed, of a digital dollar of revenue versus a traditional consumer banking or business loan banking dollar of revenue? Is it like technology where it's 85% net to the bottom line, where the competition, the old technology, is 15% to the bottom line?
Well, the way I would answer that question is I look at the efficiency ratios of the online banks versus the traditional banks.
And what are they?
And they may end up being 25% lower than the more traditional bank, just on a big picture view. Once they hit a critical mass, you'll see that they drive much lower efficiency ratios. And that's going to be the key. And that's why you're going to see more and more branch rationalization around the country to try to get those costs out.
Tom Keene, I think that's what's so interesting about the last 12 months. The holdouts, the people that didn't want to do the online banking, the digital banking, they were forced to do it. Tom, they had no other choice. Tom Michaud, you've talked about the rationalization. Just how big is that going to be and how many jobs will be lost?
Well, there will be consolidation and loss of jobs out in those facilities, but at the same time, you're seeing an incredible amount of hiring happening in the IT groups of these companies. And so I do think that headcount will come down over time in the banking industry, but it'll be somewhat of a mix shift at the same time.
Tom Keene, that has been the story, hasn't it? The rationalization, the loss of jobs over the last 10 years. You're going to see more of it.
Yes, you're right. And we all see that at the 4 branches on the 5 corners of any street. I should say the 5 branches on the 4 corners of the street. That's when young Michaud came out of Middlebury and we were overbanked. Tom Michaud, to John's point, is it 1 for 1? What's the ratio?
No, it's not. No, because we're just talking about one half of the equation, John, which is what's happening at the core, the traditional banks. But at the same time, you look at somebody like Galaxy Digital, what's happening at that company. I've heard a quote from the CEO that in the last few months, they've hired over 70 people. These companies that are standing up as competitors we didn't even know about 3 or 4 years ago, they're hiring like crazy. So, and they're still within the financial services industry. So it's all about a shift that's occurring, which I think in some ways is healthy because it's evolving as the economy's evolving.
Tom Michaud, one thing you talked about was the big question is how much can they actually increase profits going forward that really will stem from loan growth. We've heard from a lot of the big banks already that has been a challenging area. How concerned are you about the lack of loan originations, the lack of demand as a result of cash flush consumers and corporations?
You hit the tension nail right on the head because that is the question. So just to set up what the tension is, I think with investors in the market right now is credit quality far better than anyone expected, and results continue to exceed expectations. Negative loan loss provisions. I saw some banks recently had practically 0 net charge-offs. Remarkable. Capital is building. 80-year strong balance sheets getting stronger. There's $800 billion of excess liquidity, we think, in the banking system right now. That's the fuel for, we think, a lot of growth. The problem is you're not seeing it right now, because the demand for credit from the private sector just isn't there. And so if the economy is as strong as many people think and we think, and what the industry is saying, is some of this excess liquidity will be soaked up. And we'd like to think that by the end of the year, you'll start to see revenues begin to grow as core loans begin to grow. If it doesn't happen at year end, I think it's a question of when, not if. And that's what investors are looking for right now, because you're not seeing it right now in the industry, but the industry's in great shape to grow when that demand comes back.
In other words,
that's the next leg of this rally. But the rally we've had since last September is the credit improvement rally. The next rally is going to need to be the revenue growth rally, which really hasn't started yet, but people believe it will.
And this is the tension right now, this question of how hot can the economy run if that loan demand doesn't pick up materially by year end. What you're saying is different from what I'm hearing from other analysts. You're saying that if it doesn't pick up by year end, it just is a matter of when. It's not a question of whether the economy is truly hot or not. Do you think, for example, that we are going to see banks be able to profit from this hot economy in a way that perhaps people are discounting as a result of not seeing that loan demand?
Yeah, I do. I do think that banks will participate, but I think that you're going to really start to see a separation between the winners and the losers. And I really believe that if you're an old school bank that is in an area that's not a faster growth area and haven't really invested in a lot of the new engagement of technology platforms, there's a chance your growth curve could be left behind. But I think that the major players, and that's why you're seeing the consolidation, you're seeing bigger banks stand up so they can compete with really the non-banking challenge that's happening. And I think that's the big surprise. And that's what Jamie Dimon talked about in his annual letter to shareholders. I do think the growth will be there. I think it's a matter of when, not if. And I think the banks have done a good job of keeping their companies in good shape to be ready for it.
Hey, Tom, it's always great to catch up with you, sir, to get your thoughts on this sector. Always appreciate your time. You know that. Thomas Show there of KBW. Bank of America in the pre-market up a little more than 1% off the back of another stellar set of earnings. Tom Keene, these numbers have been really decent in the last 24 hours on Wall Street.
Now, decent doesn't describe it, John. This is once in a lifetime. I mean, I remember the different fevers and the why of the fevers, including huge inefficiencies in the pre-digital banking mergers that Tom and I were alluded to in early days of Keefe Bruyette, Sandler O'Neill, and the rest of them. But this is different. This I can't emphasize enough, John, how in a 7-page report from Bank of America, buried on page 5, is a small little paragraph on their digital banking. It's stunning, the growth that they're seeing in consumer banking like Zelle and also in business digital banking.
That'll be the story again for the next 12 months, but can we just touch on the story of the last 12? Just briefly, they released $2.7 billion, a reserve release of $2.7 billion. How wrong so many people were about what this economy would look like 9, 10, 11, 12 months ago. Now, they're always going to reserve conservatively, Tom, but to see the levels of these releases, I think just really underlines that things are so much better than people anticipated 9, 10 months ago.
That's true. They were dictated to do that by all sorts of good regulations and laws, but certainly in the natural disaster of a pandemic, there was a reaction. And I'm sorry, I'm going to go back to the good news of one single item, and you can spell it Pfizer and Moderna.
Things better than expected, Lisa, and a lot of that comes down to the vaccine effort.
Yeah, the pendulum is shifting now, and the question is come on, Tom, I had to do this for you, but the idea now is how can you juice revenues, which is a shift from are these banks going to fail? We got the answer. No, they're not. They're going to be over-reserved, and now they're releasing them. Now the question is, how much risk can they take to improve their profitability, John? And this is actually a question that you asked, which is, are banks actually loosening some of their lending standards as they try to get loans? What are the potential risks there? We're certainly seeing it in markets, and there will be pressure on these banks to take risks so that they can boost their profitability, at least by shareholders. And that tension we're going to see build throughout the year.
I don't think anyone thought that we were going to have a massive balance sheet issue at these banks. I think that was a minority view that some of these banks could get into massive trouble 9, 10 months ago. We had a huge helping hand from the policymaker. I think this was always going to be an earnings issue, and the story has just got a whole lot better for these banks going forward. And I'm with you. Where does the revenue come from? So now it's about revenue going forward. How do they generate that revenue and leverage what's going to be a boom economy in the United States of America? And Tom, the answer to that might be, it might just take a while. Things will balance out as the year progresses.
But every quarter, the digital experience is going to make the strong stronger at different sizes and the weak weaker. I'm with Michaud. There'll be further consolidation.
We'll have that conversation with Bank of America Chairman, CEO Brian Moynihan a little bit later on, 5 p.m. Eastern, with our good friend and colleague, David Weston. In a bond market, yields are lower by a couple of basis points, 161.48 on 10s. Bank of America doing nicely in the pre-market. Your equity market up 18 on the S&P 500. We advance 0.5% as we count you down to retail sales in America. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. In a phone call with Vladimir Putin, President Biden warned that he would defend U.S. interests. The president's next move could come as early as today. The Biden administration is expected to impose sanctions on Russia for alleged misconduct, including efforts to disrupt the U.S. presidential election. A number of Russian individuals and entities would be punished. For the first time, the entire U.S. House will vote on a slavery reparations bill. A House panel approved a measure to create a commission to study reparations for the descendants of slaves. Still, opposition from Republicans makes final passage unlikely. President Biden has ditched many of his predecessor's policies, but he agrees with Donald Trump on the need to limit exports of U.S. technology to China. Last week, the Biden administration added 7 Chinese supercomputing firms to a blacklist. U.S. businesses can't sell to them without special permission. There's little support in Congress for easing that pressure up on China. And job openings in London's finance industry soared 70% in the first quarter compared to the previous 3 months. That reflects a low baseline after a year of uncertainty over Brexit and the pandemic. According to recruitment firm Morgan McKinley, people changing jobs could expect an average 18% boost to their salary. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
We're early on in this year. I know we've already sort of penciled in 6 or 7% growth and a big fall in unemployment, but under outcome-based policy, we really want to see that.
I'm bullish on the rebound, but I know we have a long way to go before the job is complete.
There's no textbook for this. You don't want to be too preemptive, but I also don't want to be so reactive that we're late.
I think it's too early to talk about changing monetary policy while we're still in the pandemic tunnel.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
When the product was authorized, we had 2 months of data at the time because of a crisis. Now what we have is we're continuing to follow on people on the study. We have 6 months at above 90%, which is a good confirmation that this vaccine is very efficacious.
Stefan Bancel there, the Moderna CEO from New York City this morning. Good morning, alongside Tom Keene, Lisa Bravitz. I'm Jonathan Ferro. Here's your equity market. We look like this on the S&P 500. Equity futures with a lift up almost 20 points now. We advance around about 0.5%. The Nasdaq up 82. We advance 0.6%. And the Russell doing nicely as well. In the bond market, yields are lower by a couple of basis points to 161.30. Going into this retail sales print, euro dollar 119.67. Tom, just a bit softer on the euro side of things, down by 0.1%. But that hasn't been a story, has it, over the last couple of weeks?
No, to me, it's been odd data. And John, I'm going to go back to yield. I know you're getting ready for the real yield. You may have to blow up the show if we get a 159 in the 10-year a nominal rate. But I'm sorry, there is a statement being made by the bond market.
A statement being made over the last several months. And then, Lisa, we pause. We pause on a 10-year at the end of March. We collect our thoughts and we look ahead to the data we've been anticipating for a long, long time.
And we ask, how long can this continue? Is this a short, hot boom like Morgan Stanley says, or is this the beginning of a longer-term push into inflation, which a lot of people are starting to reject outright as they look out at low growth in the near future?
And Tom, what does that mean for the bank sector?
Well, what does it mean for the bank sector? It's simple. It's a boom bank economy within a boom GDP. Let's bring in Allison Williams right now. She's been very helpful here, of course, with Bloomberg Intelligence. And to go to Citigroup. Allison, I want to go back to my Ute, which is in the car leasing business. There was Hertz, and then there was Avis, and then there was sort of everything out there. Where does Citigroup fit in the continuum of JP Morgan and then Bank of America and then?
Well, I think they do have a bit of a different business model. So Bank of America and JP Morgan a bit more similar. They have these big U.S. retail footprints. Citi has more of a selective footprint in the U.S. and around the world. And so what we're going to be looking at for them is what's happening with international credit. Obviously, in the U.S., things are doing extremely well. We're seeing big reserve releases. How are things doing internationally? And, you know, the question of the day, loan growth within card. So their specialty is card. And that's where we've gotten sort of the disappointment across the companies. Everybody's looking for that second half recovery, and now you're starting to hear this bubbling up of, well, maybe it'll go into 2022.
I mean, Allison, I look at Jane Fraser and the huge challenge she has. I'm going to cut to the chase, and we're not going to hear this from anybody. Are they number 3 or number 4? So they've got to go international. Are they forced? Are they compelled to go international?
Well, I think they have not tried to change that footprint. So they've always been international. I would say that that's more of a, you know, these other banks have really built up their footprint. Years ago, they built it up through acquisitions. They can't do acquisitions now. But Citi could have made the choice as they continue to expand. Do we expand our footprint? Do we do what they've done, build out more branches, become, you know, more of the mass market retail? And they haven't. They've said, instead, we're going to refine, we're going to keep our focus on a certain client segment globally.
Let's talk about the global story, Alison, just briefly, and indulge me if you can. Europe versus the United States is a conversation we had coming out of the last particular crisis, and what happened in the first couple of years really set the stage for performance through the whole cycle. How do you think things stack up right now?
So I think, you know, you really zeroed on the critical factor, which is that the U.S. banks, because they took their pain a bit faster and because they benefited from a good economy, they had this virtuous cycle of investing in technology, gaining market share, and that has really continued. And at, you know, sort of the beginning of this year, actually for the last couple of years, at the beginning of the year, we questioned how much more market share can these banks gain in the global investment banking business. And last year we saw some Europeans have some issues with the structured derivatives business. That's really sort of a nature of mix and what happened with dividends and the differences in the market. But regardless, they had some pain, and that was the one area where we saw staff cutting in equities last year. This year, we have prime brokerage, so we have a really strong equities quarter. We have Credit Suisse taking a sizable charge. We have UBS, actually revenue expected to be down with their expected loss. So meanwhile, prime brokerage at Goldman Sachs, record prime balances. And if we look back to what happened with Deutsche Bank a few years ago, it's a very different story. Granted, Deutsche Bank had capital issues.
Yeah.
But I think the thing is, once your prime brokerage business, it's very dependent on counterparty risk. Once it starts to struggle, all of these U.S. banks are probably looking to up their game there.
And Lisa, I think this is why this moment's so important. It's not just about the global climate. It's not just about the weather. We saw this with Goldman yesterday. It's about execution.
Yeah, and this comes to the question of capital markets as well, Allison, which is where I wanted to go. We kind of keep shrugging off the capital markets' tremendous performance. I mean, just to put this into perspective, this is probably going to be the best quarter for banks going back the pre-2009 crisis. How much are people discounting capital markets, equity trading, debt trading, perhaps unnecessarily saying, this will fade, when perhaps it will be a stalwart of these firms?
Well, the one important point, I think, is that the first quarter does tend to be the strongest quarter. That's sort of adding to maybe people shrugging it off. But if you look at someone like Goldman, their earnings were so strong that they've just made 60% of their consensus profit yesterday, right? So numbers have to go up. Their quarter was about 75% of full year earnings for the past 3 years. So I'm going to put that in context. And while people might shrug off like, well, we just don't know if it can continue, and that's why we don't give them the same credit. But that money is real, that excess capital is real, that's money that can be returned to shareholders, that can be invested in businesses. So you will see that, you will see the value of that. And by the way, all the banks said, things are continuing. And so because of the seasonality in the first half, even if things do slow in the second half, even if we do say, well, things are going to get worse, we've already locked in such a big chunk of the year that there's less risk to the full year estimates, and you already have all that money to invest and allocate towards capital use.
Alison, always good to catch up with you, and looking forward to catching up with you later. Alison Williams there of Bloomberg Intelligence on these banks. And one of the stats of the last 24 hours from Alison, Tom, Goldman in the first quarter delivering 40% of the year, at least in terms of what people expected Goldman to deliver this year.
The growth is there, but the Citigroup and what we're going to see at 8 a.m., Jane Fraser, I'm going to say, John, maybe this is Ms. Fraser's first real statement as leader of the new bank after Mr. Corbett. And John, let me ask you a question. Would people in the United Kingdom want to do consumer banking at Citigroup or Bank of America?
In terms of the customer or the employee?
The customer, the culture.
I think the customer might do. Why not?
I'm asking, in France, in Germany?
I mean, if you say the employee, I would have said if they get paid.
John,
I mean, if
you're
you're thinking
from
about
London.
Investment banking or to the consumer, that's always the way, Lisa. You asking if I would I bank?
You're British.
The Tots need naming rights with Citigroup. That's what they need.
This show is transitory, John. Don't worry.
I would bank with them, Tom, if that's what you wanted to hear. Mark Howard of BNP Paribas, he's joining us in just a moment. It's a French bank, that's right.
You nailed that. Thank you.
From New York, this is Bloomberg.
No, we are so on today.
That Norway sells way more electric cars per capita than the U.S.? Norway. Well, I won't stand for it.
In this neighborhood just outside Oslo, the majority of cars are electric. Last year, Norway became the first country in the world to sell more electric cars than any other. In December, EV market share was at 67%. In 2025, the country wants all cars sold to be zero emission.
Hey, Norway, listen up, you fish-loving... Oh, this place is adorable. Damn it.
But why is Norway leading this development? The country is rocky, it's ice cold, and with huge distances. The easy answer is politics. By giving the consumers benefits that pay off, more people will go electric when they're getting a new car. These perks could be no VAT when buying the car, reduced tolls, the possibility to drive in the bus lane, and quite a bit of free parking as well. 2021 is an election year in Norway, and the Climate and Environment Minister Sveinung Rotevatn believe the EV perks will be a hot topic in the campaigns, where removal of the perks is set to be a central issue.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
There's a high bar to meet for earnings, but I think there's potential for some decent pockets of outperformance.
The hope is fiscal kickstarts the economy, generates the private sector demand, and then banks can be happy again.
2021 inflation is important. I think for markets, it's 2022 inflation that's more important still.
Everything we follow would suggest every bit of inflation is being passed through and then some.
The market overly priced for that inflation risk in the near term. We're still going to have higher inflation to come.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Retail sales 90 minutes away from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures up nicely on the S&P, up more so on the Russell this morning. The S&P 500 advancing at 0.5%, a big number expected a little bit later this morning, Tom.
John, way up. It's the way there's green on the screen with the equity markets. It's truly across the board and frankly a very traditional format. Maybe that's the banks leading the way here off of what we saw with Bank of America. The VIX isn't giving me that market. The VIX at 16.85 is feeling like under 16. Maybe we'll see that as we move to Citigroup and beyond.
Here comes the boom. Citigroup earnings in about 60 minutes time. Tom, before we get there, we need to discuss the Federal Reserve and how that recalibrates over the next couple of meetings.
Really glad you brought this up. You're like seeing, John, it's like we're zoned in together.
I know.
And it never happens. We're going to talk to Mark Howard about this, but let's get out front. The pros folks don't look to the next Fed meeting. They game out the meetings afterward, and Mr. Howard and others, John Ferro, are really focused not on April, but on June 16th.
For good reason, Lisa. In June, we get the forecast.
Yeah, perhaps they'll give us a little bit more insight, although, of course, Fed Chair Jay Powell is saying, you guys pay way too much attention to forecasts. We're looking at the data, and this is really where the proof is going to be in the pudding. I'm glad that Dr. Phil has worked you guys out as far as getting in sync. There is a question, though, John, and you're talking about how there is a lift to markets today. I wonder how much of it is because of all this cash sloshing around checking accounts, savings accounts. Where else is it going to go right now, given some of the frictions in the labor market, given some of the supply chain delays? And that, I wonder how much is going to be a theme. Valuations can keep going up, even if growth doesn't necessarily outperform so dramatically.
I think you're giving Dr. Phil way too much credit if you think one session can sort out what's going on between Tom and I.
It was more than that.
No, I think this is an ongoing series of therapy, twice a week at the moment too. In your equity market, we look like this on the S&P 500. We advanced 21 on the S&P. We have a lift up 0.5%. Tom leading towards the small caps, up by what now, Tom? Almost 1% on a session.
1.06.
There we go.
Up 1.1.
Up 0.7% on the Nasdaq 100, and yields in a couple of basis points. 161.30. Interesting take this morning. Interesting market more broadly, Lisa, going into this retail sales print a little bit later this morning.
Yeah, when you hone in on the idea that 10-year yields have actually come in, I wonder how that's going to affect bank earnings and some of their outlooks heading forward. Not seeing it so much so far. Citigroup set to report earnings. We had expected them at 8 a.m., but we're expecting them any minute because why not? That seems to be how things are going. Very interesting to see how they they are seeing loan demand as well as what they may do with all of that cash that they have in their reserves. This question of what will they buy? Are they looking?
Yeah, all are going to have to cancel order to sell short Bitcoin. As you can see, it took a couple of hours to keep this order on hold, and as you can see, it moved rapidly down. So the order to sell short Bitcoin cancelled. So if you decided to trade Bitcoin, you need to cancel as well. And stay with me. I'll let you know what's going to happen next and when I'll be able to place new orders to trade Bitcoin. All right?
Can they build those back up so that they can actually get the goods to people that people want to buy? And also housing sentiment data from some of the builders. Sentiment's roaring. The question is, can they get the lumber, which is also soaring in terms of prices? Can they get people to pay some of the prices that they need to demand, both because of their supplies as well as just the shortage of houses available, John?
Lisa, thank you. Looking ahead to retail sales and the data shortly after that. Lisa mentioning the Bank of America numbers and the work of Michelle Meyer and the team over at Bank of America, Tom, over the last couple of months, and indicating where they've done their work, and it's the card spending. The card spending has just been absolutely tremendous over the last several weeks in America, and not just relative to 2020, but also relative to 2019.
Oh, I'm going to go, John, on a behavioral basis here. I mean, we heard earlier from a guest about some of it was pent-up demand. Maybe we're buying forward what we would buy in July. We're buying now. My answer is we don't know. It was a natural disaster. We're still in the natural disaster. I noticed, John, last night, the number of people watching Babu with the Detroit Tigers in Houston was huge because Texas has people in the stands and everybody else doesn't. I mean, it's these nuances of consumption, which are absolutely original.
People want to get back to normal. I am shocked you still haven't mentioned the Red Sox. Shocked, and I'm shocked you still haven't taken a dig at the Yankees.
John, if you're dealing with a team as esteemed as the New York Yankees, you understand that anyone from Boston never talks when things are good.
So we're at 9 in a row.
We go
I'm going to
radio
talk for
silent.
you. I'm going to talk for you just to try and make things go bad. We're at 9 in a row. Is that right for the Red Sox?
John, do you understand the difference between American League ball and National League ball?
Do you think I've got a clue, Tom? Really? I go to the games sometimes.
Look, I try to
getting
play
back into
smarter
Yankee
football.
Stadium.
In the National League, the pitcher bats, and much more importantly, they advance the runner by bunting. On radio, folks, I'm doing the bunting with the bat. Bunting's really hard to do, John. The Red Sox played small ball last night. They're in the American League, but they played National League ball last night.
Thank you for that. I just know that the Yankees need Tanaka back quickly.
They do.
Very good.
Nailed that,
Got to
John.
sort out their pitching.
Wow.
I know. Mark Howard's impressed too. BNP Paribas senior multi-asset specialist joins us now. Mark, good to catch up, sir. We won't talk baseball. Let's talk markets. Peak expectations. Have we seen peak expectations for this economy?
You know, domestically, Jonathan, I think you're right. I think that there's a concern, at least in the near term. We you know, as Tom rightly highlights, we're in uncharted territory. There's a lot of unknowns as we look beyond 3 or 6 months, and we're getting that sense from the companies as they report. You know, you look at the banks in Q1, a lot of their results that we've seen out of the 3 or 4 already has been around markets. And as Lisa's pointed out, that interest margin, loan growth has been uninspiring. And with the decline recently in yields, it may not become inspiring soon. So what I'm hearing from big institutional clients is some concern. And as Tom said, they're moving towards small ball. The big fat pitches in Q1 are not as likely in Q2. In fact, with the big June Fed meeting that you talked about, there's a lot of angst. And of course, May is always a month when people talk about selling in May and going away. So I think it's about small ball. There's a lot of unknown. And as you know, we had Coinbase yesterday. We've had a big, exactly, Bitcoin base, BitDog, whatever you want to call it, Tom. You know, there's a lot of frothiness that people are concerned about, and there are episodes of stress, and that's got people a little bit anxious.
Okay, well, we like the walls of worry, Mark. Mark, I want to go to what John Farrell said yesterday. Away from loan growth is the demand for loans. Is there a demand for CapEx? I don't observe it yet in the earnings season.
You know, there's traditional CapEx and there's nouveau CapEx, Tom. I think, you know, you see it out of B of A. You heard it from Jamie. the big banks are investing in technology. Some of that is facilities, and some of that is R&D, and some of that is people. But there's definitely investment there across virtually every industry that we cover and we look at. But yeah, there's also some bricks and mortars. There's semiconductor. You've heard about Intel dropping $20 billion, and other companies that are bringing business and facilities back on shore. So I think it's a little bit of both, and I think that's going to ramp over the course of this year.
You talked about possible nodes of credit stress, Mark, and walls of worry are familiar to me, so let's go there. You were talking about the potential for another canary in the credit markets over in China following the Archegos situation and the Greensill situations. Can you talk about why this is a concern, the trifecta of problematic credit nodes?
Well, Lisa, I've been around a long time, and I'm a student of looking at canaries and things that might actually cause disruption down the road. And, we've learned going back in prior cycles, when you have an extended period of significant central bank stimulus, excesses happen. And they don't always happen where you expect them to happen. They happen in pockets and corners that you're not necessarily paying close attention to. In 96 and 97, it was in South Asia where people didn't necessarily expect it. And of course, go back in 07, it was in pockets of subprime and securitization. So we're now seeing some of these more esoteric fields or areas where people, maybe haven't been paying as much attention. And, that is something to pay attention to, because what we see with investors and potentially with regulators, whether it's in China, Europe, or the U.S., they're going to pay close scrutiny to these areas that kind of have blown up.
Hey, Mark, it's good to see you. Mark Howard, BNP Paribas Senior Multi-Asset Specialist. Let's build on that last point. Larry Summers, in an interview with the Financial Times and Martin Wolf very recently, talked about iatrogenic volatility. The iatrogenic word, Tom, a medical term for an illness caused by the therapy. And in the context of markets, I think that's something a lot of people are talking about, and Lisa's been banging on about now for the best part of a decade, I think. But Tom, it's worth discussing, I do think.
Yeah, it's worth discussing. Let's bang on about it right now. I look again at the wall of money, and to me, John, it's absolutely original economics. And much more importantly, it's absolutely original finance, as you see in the profitability of the traditional part of banking. It isn't there.
Lisa, this is your moment. This is it.
Thanks.
I've teed it up beautifully for you.
All right, listen, and I'm going to say this and you're going to roll your eyes, but the whole seeing around corners thing is important here. And the idea here is, what are the low probability events that are mispriced in markets? What are we missing? Are things too perfect? Nobody is talking about another credit collapse. No one is talking about another crisis like what we saw in 2008. But could there be something brewing that we're not expecting and not accurately pricing? And that, to me, is a significant concern at a time of post-crisis tights in the credit market when it comes to spreads. I'm not saying that there's going to be a collapse. I'm not saying that this is going to be doom and gloom. What's mispriced, though, John?
What if you're always seeing the wrong thing when you're trying to look around corners, and you've been doing that for a long, long time?
Well, I would say this.
Eventually, do you start to capitulate?
I'm not taking a stand in terms of that, but it's more a matter of...
I'm just saying, hypothetically, what if you were looking around corners and always seeing the wrong thing?
Well, the question is, how do you calibrate a portfolio, right? It's not necessarily just about making one unilateral bet. How do you accurately price risk, John?
Did you enjoy that?
Yeah, that was fun.
Just to let it out. Was that cathartic?
Yeah, I mean, I'll continue letting it out. Good. It's not done.
We all know that. Coming up next, Congressman Andy Barr, Republican from Kentucky, from New York City this morning. Good morning. Alongside Lisa Abramowitz and Tom Keene, I'm Jonathan Ferro. Equities up 19 on the S&P 500, up 0.5%. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The Biden administration is poised to impose sanctions on Russia. Russian individuals and entities will be punished for alleged misconduct, including efforts to disrupt the U.S. presidential election. The moves could be announced today. In a phone call with Vladimir Putin, President Biden warned that the U.S. would defend its interests. Fed Chair Jerome Powell says the central bank will probably scale back its bond purchases before considering whether to raise interest rates. In a virtual event in Washington, Powell sketched out the Fed's exit strategy. He says rates are unlikely to be raised before 2022. President Biden's critics say that pulling U.S. troops out of Afghanistan will obliterate American leverage over the Taliban. The president plans to pull the final American combat forces out of the country by the 20th anniversary of the 9/11 attack. Secretary of State Antony Blinken made an unannounced visit to Afghanistan today to try to sell the president's decision. And Merck has halted development of 2 experimental drugs for patients hospitalized with the coronavirus. It's begun a final stage trial with one of the drugs, a highly anticipated antiviral pill. But now the pill will only be used for people with milder disease after there were mixed results about the medicine's benefits. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know that racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America. BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The economy at this point does seem to be at a bit of an inflection point, and that makes sense with ever more widespread vaccinations, with strong fiscal policy, with continued support for monetary policy. You see the economy opening. You can see ridership on airplanes going up and people going back to restaurants. I think the March jobs report that we recently got shows what that can look like.
It is a struggle to get a reservation in New York City, that's for sure. Jake Powell, the Federal Reserve Chairman, speaking in the last 24 hours from New York City this morning. Good morning to you all. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. We are 1 hour and about 12 minutes away from retail sales in America. Citigroup set to release earnings, scheduled to release earnings in about 42 minutes, but at the moment, who knows? Bank of America came out a solid hour early. Equity futures up by 18 points on the S&P 500. We advanced 0.4%. Yields coming in, Tom, a couple of basis points on a 10-year, 161.48, and euro dollar. Euro negative 0.1%. Euro dollar 119.67.
Very good, John. Thank you so much. Joining us right now, Andy Barr. He is a congressman from Lexington. That would be the 6th Congressional District of Kentucky. Andy, I first got to go to the most exciting 2 minutes in sports. You are going to do the Kentucky Derby on May 1. Tell us about the crowd there, given the pressures of this pandemic.
Well, Churchill Downs is excited to return the Derby to the first Saturday in May. That's the traditional day. It's always been run with two exceptions. Once in 1945 during World War II, and the other was last year during the pandemic. So we're excited, even if the crowd will be a little limited because of social distancing requirements, maybe a little less than half capacity, but still the most exciting 2 minutes in sports will be returning to Churchill Downs on the first Saturday in May.
Congressman Barr, some of my ancient ancestors were named after a gentleman named Henry Clay. There were two generations of Henry Clay King. You went to the Henry Clay High School in Kentucky, and it is a symbol of the tensions of race in this nation back well over 100 years and forever. Please discuss reparations and the tensions that you see between the two parties as we engage this debate again.
Well, no doubt there's so much partisanship in Washington, and you know, President Joe Biden, who is a member of the other party from me, gave, I think, an uplifting inaugural address calling for unity and bipartisan solutions. Unfortunately, ever since that speech, we've seen a president govern from the hard left. As Karl Rove observed recently in the Wall Street Journal, this so-called infrastructure plan, which is really more of the Green New Deal and tax increases with no real effort to reach out to Republicans, it's really solidifying President Biden's reputation as the most profligate and partisan president in history. That's a strong statement, but unfortunately, there's really not been any genuine outreach to the other side of the aisle. Look, both parties deserve blame for this, but I would like to see this president and congressional Democrats in the majority reach out and just at least entertain some of our ideas.
Congressman, you said both parties deserve some blame for this, and this does seem to be the playbook, that every time there's a new president, the other side says it's not bipartisan at all, and that president goes it alone and says, well, we couldn't get anything done if we actually tried to do it in a bipartisan level. What could Republicans do right now better to actually move closer to a bipartisan solution?
Well, look, this is not an infrastructure bill that the president is proposing. It's a $3 trillion left-wing wish list. Only 5 to 6% can be adequately described as financing roads and bridges, which is what both parties say we need. The most generous definition of infrastructure, which would include things like high-speed internet, broadband, ports, airports, even electrical grid reliability upgrades, those kinds of infrastructure investments, I think, would earn bipartisan support. But in this bill, only account for about 30% of the total spending. We have a new definition of infrastructure, including the care infrastructure, which is really just a massive expansion of Medicaid. And then you have some of these other unrelated items, Green New Deal items that were included. But then on top of that, there's no consideration of Republican ideas on financing, public-private partnerships, and streamlining of permitting and regulatory reform. None of those Republican ideas are being even entertained. It's just more big government tax and spending, and unfortunately, a huge, massive tax increase that will bring us back to the bad old days of corporate inversions, moving jobs overseas, stagnant wages, and I would argue much lower wages. The National Association of Manufacturing says we're going to lose 1 million jobs in the first year if these corporate tax increases go into effect.
Congressman, if there was some sort of agreement that was smaller, say an $800 billion, $650 billion, some Republicans are asking for a bipartisan infrastructure bill targeting the areas that are more commonly thought of as infrastructure, would you be willing to raise taxes to pay for it?
Well, I think we ought to consider user fees as a way to finance infrastructure. That's the way we've always done it in this country. But to make America less competitive by not just increasing the corporate rate from 21% to 28%, but taking our corporate tax rate to a level that's higher than the tax rate in communist China, raising it to a level that's the highest among all developed nations. Because remember, it's not just raising the rate from 21 to 28% that the president is proposing. He's proposing to do so without removing the base broadening reforms that we put into place in the Tax Cuts and Jobs Act. And when you add on top of the federal income tax rate, the state and local corporate tax rates, that's where you push American corporations into a very non-competitive position.
Congressman, one final question, and I do this after President Trump gave support to the senator from Florida a few days ago, and of course with your lifelong work with Senator McConnell. I want you to frame for us how you perceive your Republican Party right now. So much as it's the party of Trump. Is it?
Well, look, I mean, I think our party is broad and diverse, just like the Democratic Party is. These are broad, enveloping coalitions, but we are still the party of limited government and free enterprise. And what we've seen, a troubling trend, is that big business, Wall Street, CEOs have kind of aligned themselves with the woke left. And maybe that's a reaction to the Trump phenomenon where the Republican Party is more gravitating toward Main Street small businesses, farmers, rural America. We represent the grassroots American people, and large institutions are letting us down. Wall Street, and look, I believe in free enterprise, but if we're in this battle between capitalism and socialism, and the CEOs of the big banks, through their ESG agenda, is aligning themselves with the socialists, where are the capitalists in this country? I think we need people who really believe in free enterprise, and that's Main Street small businesses and entrepreneurs across this country who really believe in limited government.
Congressman, you are a skilled media operator, because you must know I've only got 40 seconds left and can't ask any follow-up questions.
See how he did that? He's gifted.
Andy, can you come back so we can pick up where we left off, please? There's some really important points we need to talk about. Congressman Andy Barr there, Republican from Kentucky. Thank you, sir. Thank you very much. Tom, some fiery points at the end that do warrant a little bit of a comeback and a conversation.
Well, that's the way it is. I think we need to make a trip, May 1, down to the Derby, the three of us. Can you imagine Lisa with that?
To pick up on that conversation.
Lisa had the hat going.
Coming up, George Borey,
it's a
Wells Fargo Asset Management Fixed Income Specialist. Yields lower, retail sales 1 hour away. Look at them go.
Bet $1 or $2.
This is
Maybe
Bloomberg.
I'll bet $5.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
60 minutes away from retail sales in the United States of America, and we are looking for a boom number at Bloomberg Economics, something close to 10%, month on month. Equities ahead of that, futures higher by 18 points on the S&P 500, up 0.4%. The Nasdaq doing nicely there, up 0.6%. Tom, looking at the small caps, great year to date so far. And on the session, up by 1 percentage point too. Switch up the board and get to the bond market. This is how I'm going to look at things, not today necessarily, but through the next couple of months. 2s, 10s and 30s. At the front end of the yield curve, we're going to get pummeled by better data in America. And we'll be unmoved through a lot of it, with yields pinned to the floor at 16 basis points on a 2-year. But at some point in the future, Tom, we start to get a move. We'll start to get a move and a reaction to positive data because people will start to have a real conversation about the Fed also making a move. That's not necessarily the story for today, but it could be the story in a couple of months.
Yeah, the real conversation is going to be an original conversation, John, and more than anything, what I know, George Boyer will talk about this in a bit here, but the original conversation is going to be the diffusement of all that fiscal stimulus and monetary accommodation, and that's a complete mystery. Anybody who says they can predict it is out of their mind.
So that's what we're looking for, not just the data, but also how this market responds to that economic data.
Yeah.
And we'll look for that in about 60 minutes' time. Switch out the board and get to this. It is about expectations, and I think that's what we're really getting to
I thought you were going to do Coinbase.
Right now. No, I'm doing this for you, Tom. Romain's going to do that for you in a moment. Okay. At least you hope he is. I've got no idea if he is or not. This is the expectation story of last year, and I touched on this a couple of weeks ago. We came out of lockdown, we reopened, and the bar was just set too low, and we exceeded those expectations, and you see those positive surprises on the chart. If you can't see the chart and you're on radio, let me tell you, it's steep and it heads towards the right. The story right now... Thank you, Tom. The story right now is the bar is set here, and I just wonder whether we can get the same kind of lift that we saw relative to expectations that we saw last year, or whether we've been conditioned to understand how quickly this economy can snap back. Once again, something we need to look at through the next couple of months as we have a bar right up here for expectations that we do get a boom this year. I'm looking at Romain's chart, and he does have Coinbase, Tom, so you're lucky. Good morning, Romain.
Yeah, it's probably Coinbase after you got out.
All right. Well, I always try to deliver here. Let's actually start with Bank of America because you're talking about the economic recovery there. Good. And we did hear from the executives basically saying, look, they do see the economic recovery intact, credit costs going in the right direction. And, of course, as expected, that trading revenue doing quite well. Bank of America at 40.37 here in the pre-market. Interesting news moving here on GlaxoSmithKline. The ADR is right now at 37.50, up about 4% here on a word from the Financial Times. The Elliott management apparently taking a sizable stake, a multi-billion pound stake, I should say, in the drug maker. Remember, this is probably one of the big laggards in the drug space. It never really recovered from that COVID drawdown. It was down about 33% from its all-time high, still down about 24% or so from that all-time high. So you can see why an activist investor might want to sort of kick the tires here and see if he can extract a little bit more value. And how's this for value, Tom? It was quite a day yesterday for Coinbase. And look, we should just first say, by every fundamental measure here, this was a successful listing. You had us listing at 250. It debuted at 381. Yes, we peaked at above 400, and it came back down to close around 320. But still, you have a stock that was valued in the private market at around $90 billion. Yep. As of yesterday's close, in the public market, it was valued just below $90 billion. It's getting a little bit of a bid here today, 353 right now in the pre-market. You got word here, Tom. Kathy Wood jumped in yesterday. 3 of her ARK ETFs picked up about 750,000 shares. How many did you buy?
I didn't buy. Pharaoh loaded the boat, and I think he got out, I don't know, 400 or something. Romain, what I would note, very quickly here, Romain, what I would note is
you nailed it, Romain. I think Romain knows this. If I was making the money that Tom was describing, Romain, I wouldn't be it.
John, you have to read Ms. Ellis over at MoffettNathanson, who has a $600 price target on Coinbase.
I'll do my best. Romain, you got anything left?
Yeah, well, if you care. I mean, there's a
I always care.
I don't know. I mean, look, there is two big deals in seriousness.
PPA.
You got
enterprise
PPD
value.
apparently being bought by Thermo Fisher. That's a big deal. PPD up 6% here
what do you think
this morning.
is, the close?
And Dell Technologies and VMware. Tom, look at this. You get back to the macro in a second. This is a big deal. Remember the big tie-up between this? They're finally sort of splitting ways. Dell going to finally fully spin off
Michael's
VMware.
been, I love Michael. He's been milking this puppy for years.
Okay. Do you still have a Dell?
Me?
Yes.
No, I don't. We got rid of it like a month ago, 2 months ago.
All right. What do you use now?
I don't know. It's like an Acer or
Robux.
I know
He uses
exactly.
Robux.
He uses an Apple Mac. It's a big Apple Mac too.
All right, guys, it's been a pleasure.
I'm sure it has.
Are you done? Romaine?
You guys can go back.
Romain's like, get
I'm
me
sure you
outta
have some
here.
big guests waiting in the
Romaine
waiting room.
Bostic this afternoon when Coinbase will be 550 or something like that. Look for the close this afternoon. Right now, George Bory joining us of Wells Fargo. Mr. Bory did not buy Coinbase yesterday, but he'll give us some wisdom here on fixed income. George Bory, John Farrow is focused on the short end of the market. How will Jerome Powell move the short end of the market?
Well, good morning, everyone. Thanks for having me on. Seems like a pretty punchy show this morning. So
Always
get to liven it up with some bond
It's transitory.
I mean, Powell has already made it very clear what they intend to do. They're not doing anything, and they're going to sit tight for as long as they possibly can. And John mentioned it before. And right now, market dominance is about expectations. Expectations are high for a very strong economic outcome. That's pretty much consensus for the most part. And expectations are that inflation is going to pop as well. We're going to see pretty strong numbers over the next couple of months for a whole host of reasons. But the question is, and John had mentioned it before, when we get to August, September, October, when we're 3 months out and if the data is still strong, in particular, if the inflation data is still strong, what does the Fed do? Can the Fed really hold the line? And this Fed has been it started to lead, but it often follows the market. The market tries to push forward. The Fed has held its line so far, but the question is, can they continue to do that if the data not only surprises to the upside, but persists to surprise to the upside? And unfortunately, we're not going to know that for a couple of months. Now, I look at a lot of near-term indicators. The data looks good, but the expectations are already very high. So Powell can sit tight for a while. We're going to see strong data. The question is 3 months out, if that data is still strong, can they continue to keep rates low? Are they going to need to signal that they will need to shift policy at some point in the future?
I think we're both on the same page here, George. This isn't a story for right here, right now. It's deeper into summer. We've got to have the taper conversation at some point, haven't we?
Right.
And do you think we need to define what substantial further progress is? Because so far, it's working out for the Fed. I think the market's on the same page, economists, market participants too. But as you say, deeper into the summer, we need a real conversation about the taper, don't we?
We do, and I think the Fed, has learned a lot of lessons from the last taper tantrum, and they, want to give as much, forward guidance as possible. And I think that's one thing this Fed will try and do with very subtle nudges, very subtle shifts in expectations. They want to lead the market to the point of actual change. They don't want to shock the market, and that is something that I think we will look forward to. Tapering will be, that'll be a bigger challenge, because once they decide to shift their purchases and allow sort of the market to more freely trade, that will be a notable shift and will affect liquidity, it'll affect levels, it'll affect rates. But perhaps more importantly, at that point in time, the market's likely to have adjusted already. And that's one thing that the Fed is doing. They're anchoring the front end, they're letting the long end move higher, they're letting the curve steepen, and that allows the market to adjust, to be prepared for that eventuality of a taper. But as you point out, John, it will be volatile. We don't think it'll be as volatile as last time, because I think they learned their lesson from the last taper tantrum.
George, thank you, by the way, for bringing bond talk to an otherwise punchy show, which has definitely gone off the rails. This definitely brings it back. There's a question sticking with tapering, of how they taper and whether the market's already priced that in. HSBC's Stephen Major actually said that yields where they are on the 10-year have already priced in some sort of end to the acceleration in bond purchases. And yesterday, Fed Chair Jay Powell said that they're not actually going to sell anything in their portfolio, just let it start to run off. Is that priced in?
Well, that's an excellent point, Lisa. And, you know, they've been very clear that they're not going to do any more. And so I think, again, this kind of relative sense of expectations is they went from kind of an accelerating program to support the market to kind of sitting now at a neutral position to allow the market to adjust. And then eventually they'll talk about their sort of wind down of the program. And what the market expects right now, the market does not expect any additional sort of liquidity or additional change in program. And so we're sort of teeing it up, if you will, for that sort of next, what I would call deceleration of the program. And that's still a few months away. They still have plenty of time and a lot of runway, if you will, to adjust the market expectations. But as you point out, as some of the pundits have already said, you know, the market is starting to expect that. And so you have, you know, the shape of the curve is probably one of the best indicators of sort of market expectations. At a 2s-10s curve of, you know, call it roughly 150 basis points, then that sort of level would tell you that the market is pretty primed for strong economic growth, a bit modest uptick in inflation, and then less support from the central bank over time. But as we point out, that point in time is still very far off in the future.
George, always good to see you, sir. Talk about the bond market.
Thank you very much. Have a great day, everyone.
Thank you. You too. George Bory, Wells Fargo Asset Management fixed income specialist, on the debate, the road ahead after some better data in America. It's not necessarily a story for this morning, but as the year progresses, as we get deeper into summer, that conversation around the Fed's next move and the sequencing of the removal of accommodation, Tom, that conversation gets louder.
Well, it gets louder, and it also is complex across the bond market, not only here, but internationally as well. I mean, you see, you know, Turkey at a 19% rate today. I know that's idiosyncratic and all that, but John, it all folds in together. It's not just about a simplistic focus on the 10-year yield.
We were expecting, Tom, some sanctions, perhaps as early as today, on Russia from the U.S. administration. This coming from the Washington Post. The United States to sanction Russian debt issued after June 14th. I understand there's some reports coming from Reuters elsewhere too, but from the Washington Post, that headline just crossing, that the United States to sanction Russian debt issued after June 14th.
And because of a disintermediation, will U.S. banks be allowed to participate in Russian debt transactions at the initial offering of them or down the road?
The suspicion at this point, Tom, the answer to that could be no, but we need to find out from the administration itself officially a little bit later, perhaps today. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Equities are up nicely at 0.4%. Retail sales in America 50 minutes away and 20 minutes away from city earnings. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. In a phone call with Vladimir Putin, President Biden warned that he would defend U.S. interests. The president's next move could come as early as today. The Biden administration is expected to impose sanctions on Russia for alleged misconduct, including efforts to disrupt the U.S. presidential election. A number of Russian individuals and entities will be punished. President Biden has ditched many of his predecessors' policies, but he agrees with Donald Trump on the need to limit exports of U.S. technology to China. Last week, the Biden administration added 7 Chinese supercomputing firms to a blacklist. And Chinese automaker Geely will use its new Zeekr electric car unit to take on tech giants like Apple and Xiaomi. Both of them also want to enter the booming electric vehicle market. We spoke with Geely's president.
Zeekr is exactly created for this. It was spun off from Geely in order to become a brand new company. No matter its brand, products, teams, organization, or its culture, which is no different from any other tech and internet companies.
Geely will still start delivering its electric cars in September. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Expect tremendous volatility in this. It's going to be unstable in terms of investors and analysts understanding what Coinbase actually is. It makes most of its money on the trading of Bitcoin and Ether. Those are the two biggest, and it's going into a lot of other cryptocurrencies and crypto assets.
That was Kathy Wood, the ARK Invest founder, CEO and CIO from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Tons to get through this morning, so let's get it started. Equity futures look like this on the S&P 500, up 0.5%, up 21 points. We advanced there in the equity market in America. Retail sales, 8:30 Eastern. Going into that, yields lower, down 2 basis points, 161.30 on a US 10-year. Sonali Basak standing by for some earnings coming out in about 12 minutes' time. Looking forward to that from Citi. Need to touch on this news around Russia. Our team here at Bloomberg were leading with the news this morning that the Biden administration is poised to impose a new raft of sanctions on Russia, including some sanctions potentially around buying new sovereign debt. So here's the quote from Reuters this morning. The officials who spoke on condition of anonymity said Biden would bar U.S. financial institutions from taking part in the primary market for ruble-denominated Russian sovereign bonds from June 14th. I stress the issue here as ruble-denominated sovereign bonds because U.S. banks have been barred from taking part in the primary market for non-ruble sovereign bonds since 2019. So this would be an addition, Tom, to that particular sanction back in 2019. And I've already caught up with Dan Tannenbaum, good friend of this program, of course, and sanctions expert, who said this would have a difference and make a difference, rather, in the same way, perhaps, that some of the restrictions around Russian capital markets did back in 2014.
Yeah, I agree. Of course, we're going to defer to Mr. Tannenbaum, truly one of the nation's experts on sanctions. We'll get him on here as soon as we can. But, John, I do agree. It really shows a push here, and it's against much in foreign policy, including the border with Ukraine. Right now, we're going to digress, and this is exactly who I want to talk to about all this Coinbase stuff, and that is Michael Wolff. He has a wonderful cross-section of experience in new technology. There is a tilt to entertainment, his acclaimed books on entertainment and technology, but we're thrilled that the gentleman from Activate could join us this morning. Michael Wolff, I look at Coinbase, and as Kathy said, it's a distributional force as well. It is set up based on an invented scarcity. Bitcoin has a structured scarce asset feature. How does Coinbase deal with the fragility of an invented scarcity? How are they going to deal with that strategically forward?
Well, the way to think about Coinbase is as an exchange, and it takes 0.5% on every transaction. So the real comparison is to the New York Stock Exchange, NASDAQ, and in fact, by the way, Coinbase's valuation is about the same as the other twos added up. So it's not a question that when we look at Coinbase, we should not be worried about the volatility of the underlying cryptocurrencies. What we really should be looking at is the number of transactions which are likely to increase.
Michael, how much should we be worried about regulation?
Well, regulation, there's a lot to be ironed out. And one of the issues is tax treatment. The IRS has said that Bitcoin is not currency, but rather property. The regulation has always taken a while to catch up with technology. In this case, it looks like it's keeping pace. The bigger issue is that this offering is really more about the sort of coming out party or the first public listing of a currency, which is going to be an inflection point for the rest of all digital currencies.
Michael, I got to say, I hope I have $100 billion party coming out to some new America. I wonder, though, going forward, just generally, whether the valuations are incredibly inflated based on everybody trying to get ahead of growth and the next big thing. How do you parse that out at a time when you've got banks flush with cash looking to buy fintech, when you've got individuals looking for the next way of making efficient payments?
What's fascinating about Coinbase is this is the first way in which individuals can take part of this new market for cryptocurrencies without being subject themselves to the volatility of those currencies. So I think we're going to see that the Coinbase is going to be held widely at this market cap. It's going to be held by index funds. And so it's going to allow smaller investors as well as individuals to take part of this entire move towards cryptocurrencies.
Michael Wolff, is it like an eBay equivalent of years ago where there's been a structure, there's been a launch, there's been a huge price repricing, an advancement in price, and now basically it's dead money forward?
I don't think so. I think that this is, once again, this is an exchange. It's likely to be one of the few exchanges that dominates this business. It's actually the second largest exchange worldwide. The largest is a company called Binance, and so we're going to see so much more activity. We've only seen so far Bitcoin as really a vehicle of investment and speculation. It's only beginning as a vehicle of payment.
Good to catch up, Michael. As always, good to hear from you, sir. Michael J. Wolff of Activate.
Exciting moment.
Got so much to do this morning, sir. Sorry to keep it short. Need to return back to this sanctions story around Russia. Nick Wadhams and the team, Jennifer Jacobs, Alberto Nardelli, leading with some of the reporting this morning around these sanctions we could expect this morning. Reuters out with their own version of the story as well in the last 1 hour or so, Tom, on the officials they've spoken to on the condition of anonymity and confirming a lot of the reporting elsewhere now about what could happen around the issuance of Russian debt and the participation of U.S. financial institutions. According to Reuters, the president would bar U.S. financial institutions from taking part in the primary market for ruble-denominated Russian sovereign bonds from June 14th. A reminder to everyone going back to 2019 that those U.S. financial institutions have been barred from taking part in the primary market for non-ruble sovereign bonds. So certainly starting to tighten things up for Russia, Tom. This is the president's first real effort at doing so.
Yeah, there's no question about that. And, John, what I would suggest is the real response here is less from Russia. Sure, we're going to get a response from Mr. Putin. Maybe they'll meet, maybe they won't. But I'm fascinated by the allied response across the continent of Europe.
Confirming some of the reporting that we led with here at Bloomberg a little bit earlier this morning. And, Tom, I'm with you. The multilateral effort that this administration has stressed over the last couple of months, will we see that on this particular stage as well over Russia?
Well, there's not only that, John, but the reason for the Biden action is, I'm going to suggest, very U.S. specific. How will the allies respond to that versus a more general statement, say, on energy transfer?
And there's the headline
in Europe.
right there, Tom. The United States to ban banks from buying new Russian sovereign debt from June 14th. Tom, that headline just crossing. The United States to ban banks from buying new Russian sovereign debt from June 14th.
Yeah, and you're going to see how ruble reacts. I want to emphasize, John, we see it weaker here by 1.6%. Ruble out to a 77 right now. You also want to see what euro ruble does as well.
Coverage continues on foreign policy, on economic data, retail sales about 35 minutes away, and on earnings. Citigroup set to report in around about 5 minutes. We'll be on top of the story worldwide, heard on Bloomberg Radio, seen on Bloomberg TV. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro with Futures Higher. This is Bloomberg Surveillance.
This patch of land in northwest Saudi Arabia is going to become Neom, a city powered entirely by renewable energy. The government hopes the site, which is the size of Belgium, will be a clean energy hub, not only for the kingdom, but also the world.
This here is at the borderline between Mission Impossible and Suicide Mission. Lucky enough, so far we've just been on the right side of the line, yeah. But you know, it's very close to that. You know, this is just smoking. This is nothing ever I've seen or heard of the dimension, the challenge. You know, I'm not talking energy only. You know, but in its broadest context, including the geopolitical dimension, including the cultural dimension.
Neom will include a $5 billion hydrogen plant run on wind and solar energy. All of the zero carbon fuel it produces will be shipped to international buyers in the form of ammonia. When it starts operating in 4 years' time, it will be one of the biggest hydrogen facilities in the world.
Can't explain Neom on the back of a set of PowerPoints and a video clip. You just need to be here. You need to, breathe it. And specifically the startup mode and, things happening, buses all around you here.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
We're early on in this year. I know we've already sort of penciled in.
Okay, day traders. And now I want to talk about the art of day trading. As you can see, I pointed out the positions we hold for British pound. We have two long positions at 137.639 and 138.272, and one short position. I'm placing an order to sell all 3 positions at the price 137.96. All these 3 positions I want to sell at this price. Okay? So what's going to happen? I'm going to end up even at these 2 positions long, because these 2 positions will end up at 0, and I will make profit on short position. All this information you can find from our strategy, and we'll explain everything how it works. And if you want to trade like this, you need to get the strategy. Okay? So stay safe. I'll speak to you later, and let's see. As soon as it will reach this level, I will calculate the profit. If you're already into these positions, broker will send you straight away your profit on these 3 positions. Okay? Stay safe, and I'll speak to you later, guys.
A strategy refresh from Citigroup and the new CEO, Jane Fraser, to exit retail banking in 13 markets across Asia and Europe. And there's a beat to talk about in the numbers themselves, Tom, but I know that headline caught your eye.
Well, it caught my eye, but as you mentioned, the retail shutdown across the world, what's so important to me, John Farrell, is the efficiency ratio, what Jane Fraser really in her debutante here, in her first time out, she's going to make very clear here what the tone is on cost and control. Lisa, Citigroup's a different bank from Bank of America and JP Morgan.
Yeah, although it is trying to consolidate some of its efforts, to your point. Just taking a look at the pre-market share price, POP, it is up now 1.8%. So clearly a response to the beat, both with respect across the board in its earnings, but also this idea of getting out of certain markets in the retail banking side. Really want to focus on equity sales and trading. Just give you this number, Tom. $1.48 billion. That is versus an estimate of $1.1 billion. It was a blowout quarter for equities trading at a time when everybody was trying to rush in.
We're going to get a report as Shonali Basak joins us, our chief Wall Street correspondent. Shonali, I want to go to what you nailed yesterday with the other banks, which is the efficiency ratio of Fortress Fraser. What's it look like?
Well, listen, she held expenses roughly flat at a time they're dealing with consent orders and also a time of reshaping the bank. So she has expenses to deal with, but that idea of exiting 13 different markets.
That's how you deal with expenses, is you exit.
Exactly. It'll be more expensive on the front end, most likely, as you deal with those restructuring costs. But on the long end, people like that they are getting more focus while still keeping a global reach, which is unique to Citigroup compared to, say, Bank of America. You know, she told analysts last quarter that she would be focusing in this bank, but not overhauling it completely. And she just took over, right? This is really her first earnings call as CEO of the bank.
Shonali, it'll be more than just about the numbers, so let's talk about the strategy overhaul as well. Do you see this as something that's been in the pipeline for a while that started with Mr. Corbat, or is this something that Mrs. Fraser came into the bank at the top of the bank and said, let's go, this needs to be done?
A little of both, right? You see Jane Fraser really coming in, setting up a new team, really changing up what that fabric of that consumer bank looks like with new leaders. But when she did take the earnings call last quarter, before she took over as CEO, in Michael Corbett's last call, she did say there would be more changes, John. She said that she understood that Citi was lagging behind peers. Remember, prior to today, Citigroup was trading at the lowest multiple of price to book than all of the big 6.
But more changes, Shonali. Does this mean more consolidation? Does this mean perhaps pulling out of more markets or more units? Or does this mean acquisitions, as we've heard from JP Morgan and others, with all that cash?
On the front end, I would look at divestitures, like getting out of certain areas first. And focusing, Lisa, that's really the key here with Citigroup is focus. The consumer business is not the same fabric. And you know, look, if you look at around the world, they're facing pressures, right? Look at the revenue in North America down 8%, Latin America down 18%, Asia down 7%. So, you know, you are still facing pressures around the world in that consumer business. How do you tidy that up? Jane Fraser was in Latin America prior to taking over the consumer business.
John, the reach here, Australia, Bahrain, China, India, Indonesia, Korea, onto the Philippines, Taiwan, Thailand, and Vietnam.
The international bank becomes less international. Shonali, it's great to catch up. Stay close, won't you? Because these headlines are still coming across the Bloomberg terminal. Jane Fraser, the Citi CEO, deciding to double down on wealth and pursue continuing exits from consumer franchises in Asia and across Europe as well. Lisa touched on the numbers briefly. Let's do that again because the numbers are decent and they're getting buried in the strategy overhaul. Fixed sales and trading revenue, $4.55 billion, the estimate 4.36. You can go in through every single line item, Tom, and the numbers are looking pretty good right now. It's been a better than expected start to the year. I think many other bank CEOs feel the same way. But here's the line that stands out for me, and I think for a lot of other people as well. It comes from Jane Fraser herself in this particular statement, Tom, seeing the healthiest consumer emerging from a crisis. That's the good story here in America, the economy. Let's get to the foreign policy story as well, Tom, because we're getting some headlines across the Bloomberg on the foreign policy side of things too. The United States issuing sanctions on some Russia debt, companies and individuals as well. We led with that reporting, Nick Wadhams and the team earlier this morning here at Bloomberg, now getting confirmation of that from the administration. The United States sanctioning 6 Russian technology companies. So they're issuing sanctions on Russian debt. We discussed that a little bit earlier on in the program. It will now be on ruble-denominated debt and non-ruble-denominated debt too. And now we're getting sanctions on companies and individuals too. As for the companies, sanctions on 6 Russian technology companies. Tom, so much to get through this morning on the economy and also on the foreign policy side of things too.
I don't know on television here if we get dollar ruble up. On radio, I can tell you 1.8% weakness in ruble out to 77. And when you're an emerging market / frontier economy, maybe what Russia is, that is a tangible move as well. John, I don't want to dovetail Citigroup into Russian sanctions. I don't think we need to do that. But I would say that when you see retail shut down, that is nothing more than expense control.
But Tom, I'd also say I think what we have seen with the likes of HSBC, it is really difficult to run a large international bank, and HSBC have been having their own problems with that. And I think that probably is the issue with Citi. I mean, how many times have we heard from the likes of UBS and Credit Suisse going back to basics, going back home? Heard the same thing from Europe too. The European bankers talking about going back home, going back to basics, going to the domestic story. And I think in some way, in some degree, and not a fantastic degree, but to some degree, I think that's what we're seeing from Citi today, Tom. Our home market, that's where the money's at, wealth management.
I didn't bring this up earlier. We couldn't get it in with the news flow, but HSBC, folks, is really becoming the Hong Kong and Shanghai Banking Corporation. They moved not 4, but 5 senior officers to Hong Kong, where John, they'll join Steve Major.
Yeah, Steve Major out over in Hong Kong now too. And Tom, it's interesting, isn't it, that HSBC doubles down on what it would consider its home region now, and the United States is Citi's, and Citi's pulling back from the likes of Europe and Asia too. I think we're going to see much more of this. We've seen a lot of it already.
Futures up 24 right now. The VIX I don't have a good reading on. Sam Stovall with us with CFRA for too short a visit this morning. Sam, you and your family have seen every kind of boom, every kind of bull market. I know this time is different. In what way is this bull market rally distinct from the others we've witnessed?
Well, first off, it's the speed, Tom. We fell 34% last year in only 33 calendar days, which was the fastest on record. We then got back to break even, recouped all that we lost in fewer than 5 months. So by August 18th, we were back in record high territory, which was the third.
Okay, guys, on record. As you can see, position closed on British pound. All 3 positions were closed. I will show you how much profit and loss we gained from trading British pound. At the end of the day, we received already confirmation from our broker that we have profit £2,800. Okay, so all of you guys who follow trades, it's worth it. We hold it for about a week, as far as I remember, and well done. For all newbies, new traders who never traded before, you probably right now discovered the secret how to day trade. Good for you guys. The other guys who already using our strategy and knows how to trade with our strategy, great. Let's move on. Let's not concentrate on one winning. Let's get lots of winnings for today. Okay, I'll speak to you later next time when I will see some new chance, new opportunity to that will arrive to trade. Okay, stay safe. Well done. Good trade, guys.
Resilient optimist, you've always participated in the market. I've never heard go to cash out of Sam Stovall's mouth. What does the Gloom crew get most wrong now in their fears out to Q3, Q4, and into next year?
Well, you're right. When life gives me lemons, I try to make whiskey sours. So basically, I think that investors have to realize that, first off, Americans are optimistic by nature. If you are bearish and wrong, you are ridiculed. If you are bearish and right, you are hated. I think basically what we are expecting is that earnings, instead of reaching $200 a share by the end of 2022, might actually come closer to the end of 2021. The targets that a lot of strategists, myself included, that placed on this year are being eclipsed or at least approached by the end of the second quarter. So I think this market is showing us that it definitely has upside potential.
I've got to say, Sam, that's not how it works in the media. If you're bearish and wrong, you keep getting invited back. You don't get ridiculed. We've seen that again and again and again, haven't we? Everyone seems to love that headline. Let's get to the headlines of this morning. Let me recap just a moment, Sam. I want to get through this. From Citi, they are to exit retail banking in 13 markets across Asia and in Europe too. The numbers out of Citi really good. Maybe one highlight: fixed sales and trading revenue, $4.55 billion. The estimate, $4.36 billion. Got a flavour of the numbers this morning, how the bank is doing better than expected to start the year, and getting a flavour of the strategy refresh from Jane Fraser at the top of the bank as well. And then, Tom, on the other side, and we've discussed foreign policy through this morning, we do get the headline: the United States to issue sanctions on some Russian debt. Companies and individuals as well. Our team down in D.C. led with that reporting this morning, and there's the confirmation right now. The president has made a big push domestically over the U.S. economy, and you rightly pointed out earlier this week, Tom, that foreign policy has come onto the radar in a much, much bigger way in the last couple of days.
The complexities of this are not just the Bloomberg world of finance. This is of international relations, and folks, you've got to believe a response out of Russia, and of course that could center on the tensions in Donbass, the eastern border of Ukraine, with Russia. Less the Crimea story, John, and much more what's going on east of Kiev.
Not a major move in dollar ruble, but you see one. Dollar ruble up by 1.7%. The dollar ruble pair right now, Tom, with a 77 handle.
Yeah, I would say there. Now, you look at it three ways, John. You look at dollar ruble. You also look at euro ruble with that geographic proximity. And then the pros at Bloomberg use a basket of currencies against ruble. I usually go to dollar ruble within the media, but nevertheless, that's where we are. Just because of news flow, we have to say thank you to Sam Stovall. Too short a visit with a gentleman from CFRA, and we'll do it again. Their chief investment strategist here with Dow, 33,786. John, the Dow up 162 points.
You're just trying to wind me up.
Got
NASDAQ 100 futures up by about 0.8%, Tom. S&P 500 futures up by 0.6%. Talked a lot about foreign policy. We'll do more on the economy in just a moment. In about 20 minutes' time, Tom, retail sales in America. But we need to continue to digest and process Jane Fraser over at Citi, making a move early in her tenure at the top of that bank.
Let's do this. Shanali Basak, one question, and then we'll go to Gerard Cassidy. Shanali, your observation as you study these earnings.
20.1% return on tangible equity. Jane Fraser just, knocked it out of the park in her first quarter. And 4.5 in terms of 4.5 billion in fixed income makes it right behind JP Morgan.
Is there a tone?
Number 2.
Is there a different tone in the presentation than we saw from Mr. Corbat and his team?
There is. There's a tone of somebody who wants to show that she's coming in swinging. And so she's, the first out of the gate, 13 markets gone. She says we don't have the scale we need to compete.
Let's go to Gerard Cassidy with decades of expert. He always comes in swinging into the lobster restaurants of Portland, Maine. He's with RBC Capital Markets. Gerard Cassidy, I want to go to cost and geographic reduction as expense control. When you give up on retail in Vietnam and in Bahrain, is that nothing more than a closeted cost reduction?
Tom, I think it is. And when you take a look at the markets that they're exiting, the numbers that they have provided really do not have a material impact to the bottom line. Now, you might recall some years back, they exited a handful of these consumer markets, and they obviously didn't go all the way. And Jane Fraser, with her first strategic move, is trying to make the company more profitable by exiting these markets where they really don't earn very much money.
Gerard, what's left? What's more to do?
It's going to be interesting because this has been the one area that of focus for many investors, that they needed to really trim down their global footprint on the consumer side. They just didn't have the scale in certain markets. So then the next question is, how do you build up scale in the United States? when you take a look at two of their biggest peers, JP Morgan Chase and Bank America, their consumer banking franchises in the United States have return on equities, a return on tangible common equities of over 30%. Citi does not match that number. So Citi will have to take a look at how do we get bigger in the U.S.
Jared, we asked this question of Shanali, and she answered it delicately, and you can answer it a little bit more aggressively, I imagine, because here at Bloomberg, we have to be slightly diplomatic, of course. But do you see this as a big change from Corbat to Fraser?
Oh, absolutely. And, you know, she indicated on the last call when she participated in the fourth quarter earnings call that there were changes coming. And we expect to hear more guidelines on new targeted return numbers, what they're going to expect to be able to achieve with these strategic changes. You know, Citi has a lot of work to do, a lot of heavy lifting, but now with the new leadership under Jane Fraser, I think they're going to be able to accomplish new and better numbers for shareholders.
Gerard, so far, who's winning in the capital market space? I mean, all of them have been beating across the board, and people have been talking about the frothy markets, but who's winning?
It looks like so far, when you compare all the numbers, Goldman Sachs came out on top in almost all the different categories, whether it was ECM, DCM, or in trading, in markets for FIC or equity. They seem to have by far the best numbers out of all of them. But to your point, they're all very strong numbers.
And there's a question of how long this can last. And I was looking at a headline about Citigroup's incredible equity trading numbers following on the SPAC-a-palooza, or whatever you want to call it. How long can these trends last to continue supporting their earnings?
It's going to be more challenging as we get into this year, unless we get continued volatility and strength in the markets, and that's hard to predict. But we should understand that the SPAC ECM business, that has started to obviously slow down because a number of the investors in SPACs, they've already allocated the money for that, and there's not as much money to go into SPACs. So now we need to see the de-SPACing. That's when they actually do the mergers. So that's going to be a lift to advisory businesses as we get into the second half of this year.
Gerard Cassidy, we talked to Thomas Schroeder, you know well, from KBW earlier. We reminisced on Bank of New England long ago and far away, the ultimate roll-ups that you were directly involved in. Do you presume another season of roll-ups because of the technological superiority of these winners?
Tom, I think you're right. We are going to see more consolidation. It's already started to pick up. As you might recall, Tom, when you and I were young men, we had 18,000 banks in the early 1980s. Today, we're down at 5,100. We expect continued roll-ups or consolidation to continue over the next 2 to 3 years, and it will be small community banks like Provident acquiring SB1 last year out of New Jersey, but also the big deals like we saw with M&T acquiring People's Bank of Connecticut. So we're going to see big regional deals, we believe, over the next 2 to 3 years, and the Canadians will likely get stronger in the U.S. as Toronto Dominion has indicated they want to get bigger in the U.S.
Jared, you're so gracious with your time on mornings like this morning. Can I just squeeze another one in? Just your report card for the quarter. We had Bank of America earlier this morning as well. We had the likes of Goldman, JP Morgan too in the mix in the last 24 hours. Who won the quarter?
I would say so far you got to put Goldman Sachs at the front of the list. They have won the quarter. But when you look at the universal banks, we've had 3 of them, JP Morgan, Citi, and Bank America. And I would say JP Morgan probably came out ahead. But they all have the same trends, John, which is these loan loss reserve releases are very meaningful. They're going to continue throughout the year. And that's going to be the bridge until we get loan growth and higher revenue growth in the second half of the year.
Gerard, good to hear from you, sir. I know you've got to run. Gerard Cassidy there of RBC. Morgan Stanley tomorrow. Shanali, just a final beat from you. Was that your take, talking to a lot of people in this market too? Goldman, the big winner here.
Yeah, the returns are very, very good. They have highlighted more levers to clamp down on costs, and they're beating on every respect. More than $1 billion in advisory revenue, which is the business that people think will keep getting stronger this year.
Mr. Solomon facing some heat earlier this quarter, but getting it done for the business and executing big time in the last 3 months. The news elsewhere, so much news this morning. Retail sales in about 12 minutes. We've had the bank numbers. We need to talk about sanctions. Sanctions, Tom, before we even get to retail sales. Dollar ruble out to a 77 handle with a move of 1.6%. Nick Wadham's at a team here at Bloomberg leading the reporting earlier this morning over the sanctions we could expect. Now we can see those sanctions. Nick, your take, please. What are we getting?
Well, we're still trying to parse out exactly what's going to happen. The big one for Bloomberg's purposes is that it looks like the U.S. is going to bar U.S. banks from buying Russian bonds on the primary market starting on June 14th. Unclear, though, looks like there still is going to be secondary market trading allowed. So, you know, it's a big top-line action, but ultimately may not affect all that much money.
Nick Wados, pre-pandemic, you lived on the airplanes with the State Department. How will our allies in Europe respond?
Well, they're still getting taking a look at the extent of these sanctions, which literally just hit. But, you know, a huge focus for this administration so far has been to do things in concert with allies. They say, listen, we don't want to have any surprises for countries that could potentially be caught in the middle. So you can be sure that they briefed allies on what was coming, including potentially expulsions of intelligence officers operating as diplomats. So we are checking to see if there's going to be a similar wave of expulsions from countries in Europe.
Nick, frame the dynamics, the fungibility, if you will, of the Russian foreign exposure right now. Not so much Syria, but their actions on the border of Ukraine, and for that matter, how they could fill a void in Afghanistan. Are they steeled to do that, or are they just not ready to create a fuss?
Well, Afghanistan always ready to create a fuss. I mean, that's a huge part of these sanctions. They're responding in part to the allegations that Russia was essentially offering bounties to Afghan fighters to attack American troops. So that's a big motivating factor here. The timing is propitious for the United States because they are seeing this huge troop buildup, biggest buildup since 2014 along the border with Ukraine. So they do want to send a very clear signal that that buildup is of huge concern, and the U.S. and its allies may try to find some way to respond. But these are sanctions that have been going in the works for months. I mean, we've been tracking them essentially since the Biden administration came into office and announced it was going to launch this big review of these perceived Russian misdeeds. But certainly trying to signal here that they're not going to tolerate that troop buildup along the border with Ukraine.
You know, Nick, I wanted to talk about timing, and I wanted to talk about who the signal was for. Is it for the Russian government? Is it for the Middle East? Or is it for the allies in order to get some sort of cohesion ahead of the China discussions? Is that a way to read some of these moves by the Biden administration?
Well, I think more what you're seeing is that the administration announced literally on its first day in office that it wanted to review all of the actions by Russia. So the cyber attacks, the solar wind hack, the Russian bounties in Afghanistan, the Navalny actions. So that what they were really addressing was a perceived idea that for 4 years under President Donald Trump, there really was no significant action at the leader level, certainly against Vladimir Putin. There were sanctions over the Salisbury Novichok attack and things like that. But really this perception that Donald Trump was pulling his punches for whatever reason with Vladimir Putin would never say a bad word. So that was a huge signaling effort at the beginning. And they announced this big review. It took them a few months to get there, and now they're rolling out what they see as a very stern response, big sanctions package.
What does escalation look like? What is the expected response from the Kremlin?
Well, I think right now what you're seeing, you're almost certain to see is expulsions. Of course, we've been down this road before. After the Trump administration did expel some Russian diplomats, Russia expelled about 400 American diplomats during the Trump administration. So, you know, there's very little that Russia could actually do that would have a financial impact, but you're probably going to see the tit-for-tat expulsions. And, of course, Russia may decide that Vladimir Putin will not attend this climate summit. This is a big initiative of President Biden's set for later this month. Russia could show its disapproval by saying, hey, we're just not going to show up.
Nick, just a final one from me about the environment down in Washington, D.C. at the moment. I just had a comment from Dan Tannenbaum over at Oliver Wyman, who pointed out just the lack of leaks around this administration. You led with some reporting this morning, but we're not talking about days ahead of time. We're talking about hours now, Nick. Just how tightly ran is that ship down in Washington?
Well, I'm not so sure about that. We reported last week that these sanctions would be coming this week. So we are, you know, on sanctions stuff, I think, yeah, I'm going to toot our own horn. Bloomberg has absolutely been ahead of the pack on these stories. There is definitely a tighter ship in terms of leaks on internal drama, the palace intrigue, things like that. So you're really not seeing any of that. Whether it's almost certain that infighting is starting to happen. Everybody was singing from the same songbook, but they are really You're starting to see a few of the turf wars, but certainly none of the drama histrionics that you saw under the Trump administration that even merited a lot of those leaks. But also there is a certain amount of fear because the administration, like the Obama administration, has said it's really going to get tough on leakers and really punish anyone who tries to do that. So we are seeing a lot fewer leaks on a lot of the internal politics within the administration.
But you're doing your job and doing it well, Nick. Don't worry about that. It's going to catch up. Nick Wadhams of Bloomberg taking a bit of a dig at reporters down in Washington, Tom, on other beats maybe away from sanctions. Tremendous reporting from the team down in D.C.
For Bloomberg Radio, a chart that I've used with the wonderful Marshall Goldman years ago on Mr. Putin and on Russia, John. This goes back to the collapse of the Soviet Union. It is the mass devaluation of the Russian ruble as compared to the dollar, John, from 1 to 1 to 1 to 77. That's a log chart. That's maybe the ugliest chart in the system in terms of wealth destruction.
It is not pretty, is it? Coming up on this program, retail sales in America, which we haven't discussed for what feels like the best part of an hour. It comes up next with Lou Alexander, Nomura Securities chief U.S. economist. We're looking for a big one at Bloomberg Economics, something close to 10%. From New York, for our audience worldwide, heard on radio, seen on TV, this is Bloomberg Surveillance.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
From New York City for our audience worldwide, good morning to you all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Retail sales in America just moments away. Going into that, futures with a nice lift on the S&P 500, up by 24 points. We advance by 5/6 The wow from Tom Keene is for claims. So let's do claims first, and I'll work through the data, Tom. Give me a second.
Wow.
A good downside surprise on claims, 576,000. The median estimate, 700K. And there is your punchy number on retail sales. Month on month, 9.8%. I stress month on month, 9.8%. The median estimate, 5.8%. The likes of Carl Riccadonna at Bloomberg Economics, almost on the money here, looking for a 10% pop for March retail sales. Had Bank of America in and around 11.5%. It's a big number and a huge upside surprise as well. If you strip out auto and gas, let's go to retail sales, ex-auto and gas. 6.4% was the estimate. 8.2% is the number. So 8.2% stripping out auto and gas. The headline number month on month, 9.8%. The control group, important input to GDP here in America, Tom. Retail sales control group, 6.9%. Just a slight downside surprise there. 7.2% the median estimate. But that is a boom number. So 2 data points here to look at. A really nice retail sales print, 1, and the right kind of move, lower on initial jobless claims, Tom. Jobless claims down to 576 from a revised 769.
You know, we make jokes about it, John, wow, and all that, and that's the showbiz part of it, but this is the healing of a nation. And what I notice is even with a revision on initial jobless claims, that is terrific good news on getting the unemployment rate down to somewhere in the vicinity of February last normal. And on retail sales, I mean, I'm sorry, these are good numbers with constructive revisions as well.
They are good numbers, but is it a market that was positioned for it? So let's run through this market. Equity futures still elevated, up 0.6% on the S&P 500, advancing 27 points. But take a look at the bond market. Yields, 160 and down 3 basis points now on the session. We've seen this with retail sales. We saw it earlier the week with CPI as well. CPI was hotter than expected, and on the day, treasuries were bid and yields were lower. And we're seeing it right now, Tom. Yields down by 3 basis points on 10s, 160, 7% on the control group, 6.9% to be precise, slightly below projections, estimates. The headline number, 9.8%, huge upside surprise. These are tremendous numbers, but we were gearing up for these tremendous numbers for the best part of 6 months, ever since we got that headline on the vaccine front in early November last year.
Well, John, I want you to bring in Ira, but you know what I'm going to notice, John, is the real yield at a negative 0.75. I'm not even sure you can do the show. Friday, see that, folks, 1 p.m. I don't even know if you can do the show with a real yield coming to a greater negative number as we've seen the last number of days.
Nominal yields down by 4 basis points on 30s to 227 as well. Let's turn to Ira Jersey of Bloomberg Intelligence, our rate strategist here at Bloomberg. Just your first reaction, Ira, please.
Yeah, I think the market was ready for this kind of whisper number, this 10%-ish number that you noted, John, that Carl Riccadonna and our Bloomberg Economics team almost nailed. So you know, so the market is actually rallying a little bit in terms of rates, and I think because I think maybe this is as good as it can get, because remember, this is a lot of fiscal stimulus is baked into these numbers. So you know, next month's not going to be quite as good, and the month after will be even slower. So I think the big question for the rates market is how sustainable is this kind of recovery?
Ira, with the news flow this morning, we're thrilled to have you on, and I've got to rip up the script here as the Secretary of State now comments on these new Russian sanctions. Ira, you've worked for Major Wall Street. What's it mean if they can't trade Russian paper, Russian full faith and credit debt?
Well, obviously that really will affect some emerging markets trading desks, but it's really probably pretty incremental. The big things for a lot of the big U.S. banks in particular are things like U.S. corporate bonds, right? That's where a lot of the issuance comes from. That's where a lot of syndicate desks make their money. So I don't think it's huge from an economic perspective for a lot of these banks, but it does, it has to increase some fear that you could wind up having more economic wars and what happens with geopolitical tensions in general. That often can lead to some risk-off type of activity.
Ira, I just want to sit on the data that we just got, the data dump that was much better than expected across the board. And looking at the bond market moves with a lower bond yield, 10-year now at 1.60%. Yesterday, Fed Chair Jay Powell said, stop looking at expectations, look at the data. The data looks tremendous. When does it actually matter?
Well, I think the problem, though, is that both he and just about all of us who look at this data regularly are going to say, okay, look, this next couple of months, you almost have to look past. So the question is how, like I mentioned to Tom just a second ago, is how sustainable is this going to be going forward? Because the fact is that, there's not going to be $1,400 fiscal stimulus checks going out every month that are going to create a month-on-month gain of 10% in retail sales. It's just not going to be sustained. So the question is, how much does this filter into the general economy, and can we see, month-over-month gains of, 0.5%, 1% on a regular basis? And I think that's really what we have to be cognizant of. What can derail that? So things like, another trade war with China, some other geopolitical tensions with Russia, all of those things have the risk of derailing some of that. But I do think that we're going to see an economy that's pretty decent by year end, a Federal Reserve that's going to signal it's going to reduce its asset purchases in 2022, and Jay Powell yesterday, Lisa, did hint at that yesterday. And so if that's the case, then those real yields that are negative 75 basis points for the 10-year can go to zero. And if that happens, and you see that kind of increase in yield, you're talking about 2.25%, 2.5% 10-year yield by the end of next year potentially, or the end of this year, I should say.
We got to run, sir. We've got to leave it there. Ira Jersey there of Bloomberg Intelligence. So we need to go through the data, look at the price action, and I'll do a little shout out as well. Let's start with the data. The right kind of downside surprise on initial jobless claims. 576 down from a revised 769. We were looking for 700K. Better than expected for claims in America. Elsewhere on retail sales, your headline number 9.8%. Your median estimate 5.8%. That is a tidy upside surprise. Though as Ira had pointed out, away from what the economists were looking for, the market was really gearing up for a big number too. So here's the price action. Equities were elevated going into the print. They stay that way. Futures elevated 0.6% on the S&P 500. NASDAQ futures doing nicely now too, up 1%, off the back of a move in Treasury yields, down by a couple of basis points on a session now, call it 3, to just above 160. So that's the data, the price action. Tom, here's the shout out. Carl Riccadonna was looking for 9.7%.
Missed it.
At Bloomberg Economics.
Way off.
Huge miss. Looking for 9.8. And here's one for you too. Lou Alexander looking for 9.5. Lewis Alexander of Nomura, Tom.
Let us talk about this, folks. John and I feel very, very strongly about not gaming people when they're wrong or right, because market economics is brutal. It's ever more brutal now, given this natural disaster we're living. Lewis Alexander joins us with Nomura, their chief U.S. economist and someone who deals micro with macro like no one on the street. Lou Alexander, what does this retail boom do to your guesstimates on the duration of a boom economy?
So 1 month's data doesn't tell you an awful lot about that. I would very much agree with Ira's point about what an important factor is the duration of the fiscal stimulus. I would point out on the big 1.9 trillion jobs plan that was just passed, CBO's estimate is they're going to spend out 1.2 trillion of that before September. That's extremely front-loaded. And so this problem of we've got this surge now, but how long it's going to last is very important. We have the peak in growth in this cycle for us is the second quarter, the quarter we're in now. And so I think that is going to be increasingly the discussion we're going to have.
Lou, how much are you looking at labor market constraints, supply chain constraints as a cap to potential growth? We know people have the cash, or at least if you look at it in an aggregate number, although it is bifurcated in terms of wealthier households and lower income households. How much can people buy at a time when you have companies that cannot hire enough people?
So a big part of the advance we're going to see over the next year is a normalization of the composition of demand. So as the threat of COVID-19 goes down, people are going to do things like they're going to go back to traveling. They're going to go to restaurants more often. And there is more capacity in that part. Where you're seeing those supply constraints, things like the chip constraints, the shipping constraints, is in the good side of the economy, which has been boosted under COVID. And I think those things are going to moderate. So as we look forward over the next year or two, I don't think the supply constraints are really going to limit what the economy can do in terms of growth. We are going to get a burst of inflation, but I think a year from now, we're going to be talking about other things.
Lou Alexander, CIBC, and Catherine Judge talk about the scale of the dramatic acceleration that we're seeing right now. Do you just assume a shift from the goods news over to an acceleration of service sector profit and prosperity?
I do think that shift has got to come. So if you look at what's happened over the last year, you've got about a third of economy that has been very depressed because of COVID-19. That includes travel, entertainment, but it also includes things like elective healthcare. Those things, as COVID-19 is no longer a threat, are going to come back. At the same time, all the parts of the economy that have benefited from COVID-related demand, all the fact that people have gone out and bought goods and stuff like that, that stuff will moderate. And so that is part of how we expect the economy to evolve over the next year.
Lou, always good to catch up with you, sir. What a morning for it. Lewis Alexander there, the Nomura chief U.S. economist, off the back of a better-than-expected retail sales print for the economics community, at least anyway. 9.8% the number on retail sales in America, 5.8% the median estimate. Tom, the price action off the back is curious, isn't it?
Yes.
Yields lower by 4 basis points. We have a break of 160, 159 on a U.S. 10-year.
I would suggest within the mix of the news flow, John, that's a huge deal. I love what Neil Dutta says with his retail numbers. He goes French on us, au revoir to the U.S. Dollar. He also says the European Union getting its act together. You got to watch a blended DXY statistic, and we don't see it yet, John. Euro through a 120. Will we get that?
Looking forward to the conversation through the day right here on Bloomberg TV and radio. In the next hour, I'll be catching up with Morgan Stanley chief economist and global head of economics, Chet Anaya, on this better economy, a better economy that this man has been looking for.
Looking for an entry
best part of 10 months. Keep waiting, Tom.
You keep saying go to cash.
It's coming.
What do you expect?
You might have missed it in the Treasury. In the 10-year Treasury, 174 to close out March, back to below 160.
The way you got out of Coinbase yesterday, John, you were courageous.
Thanks, Tom. I appreciate that. Let's go for a drink later and talk
Transitory.
about it. Yields in 4 basis points. The data's decent. Is this it? Really? This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The Biden administration has hit Russia with a new round of sanctions. Dozens of Russian officials and entities will be penalized. 10 diplomats will be expelled from the U.S. and there'll be new restrictions on buying Russian debt. That's in response to allegations that Russia was behind the massive hack of federal agencies and interfered in the U.S. presidential election. President Biden has ditched many of his predecessors' policies, but he agrees with Donald Trump on the need to limit exports of U.S. technology to China. Last week, the Biden administration added 7 Chinese supercomputing firms to a blacklist. U.S. businesses can't sell to them without special permission. There's little support in Congress for easing the pressure on China. And United Health raised its forecast for 2021 after first quarter beat estimates and earnings. The largest U.S. health insurer is the first in the sector to report and is seen as a bellwether. The company's insurance division has added more than 1 million members since the end of 2020. And U.S. health regulators have extended the pause on the use of that Johnson & Johnson coronavirus vaccine. They've concluded their meeting without a vote on the issue. Now they'll seek more data on a rare clotting side effect. That pause could cast doubt about the shot that's helping vaccinate rural communities and other harder-to-reach populations. And JP Morgan is launching a multi-trillion-dollar green initiative. The bank set a goal to finance $2.5 trillion in projects that combat climate change and advance sustainable development over the next 10 years. It will include $1 trillion of financing for projects that bolster cleaner energy sources. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
revenues coming in better than expected, everything. Cash, $1.4 trillion of cash, one of the most notable aspects of this report that was stellar.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
We will reach the time at which we will taper asset purchases when we've made substantial further progress toward our goals from last December when we announced that guidance. And that would in all likelihood be well before the time we consider raising interest rates. We haven't, voted on that order, but that is the sense of the guidance, is that it would work in that way.
The calendar for Jerome Powell, it is an interesting calendar to the April 28th Fed meeting as well. There's a calendar as well for the beleaguered transportation industry. Ed Bastian and Delta Airlines report. In the headline sequence, Lisa, is fascinating and a troubled look back, but the look forward I find just brilliant in that they're losing 11 million a day. They're making 4 million a day, and the lines cross somewhere about September optimistically.
Everyone's trying to get on planes and fly places, or a lot of people are anyway, and more than they were certainly a couple of months ago. But one of the interesting aspects of this restart that we've been talking about, Tom, is that the likes of Delta can't bring on enough pilots, enough flight attendants to get some of these flights going again. These labor market shortages very much in these services areas. Jed Kolko has been covering all of this. He is the chief economist at Indeed, which is the world's largest online job site, formerly of Trulia, out of Harvard. Jed, what's your take on how severe some of these labor market shortages are that we hear about, in particular in some of the services sectors?
It is sector by sector. We have seen a very big increase in demand for labor by looking at job postings on our site. Right now, job postings on Indeed in the U.S. are about 18% above where they were just before the pandemic. There's been a steady recovery and recently an acceleration. In some sectors like manufacturing, construction, driving, and warehouse jobs, job postings are more than 50% above where they were before the pandemic. So there's clearly been this boost in labor demand, but the boost in labor supply hasn't quite yet caught up. There are a few factors holding people back. Of course, a big one is concern about the virus still for in-person jobs. Another is the added burden that parents, especially mothers, have in still balancing distance learning and childcare with work outside the home. So still a few factors that hopefully vaccinations will help take care of.
There's a question, though, because we just got jobless claims, and every week we get these numbers, and they have come down, but there's still above 500,000 Americans filing for unemployment claims in a week. How can this make any sense whatsoever, given the fact that there is this incredible demand for labor? And yeah, I hear what you're saying, but those issues have been the backdrop for the better part of the past 12 months.
The jobless claims numbers reflect many things, including the rate at which people are able to apply. There's a lot of repeat application. I think a better view of the set of people who are open to work, looking for work, and don't expect to get called back is what I call the core unemployment rate. It's the unemployment rate minus all the people who have been temporarily furloughed. And that is still elevated, but it never went as high as it went during the Great Recession. The unemployment rate that we saw during this pandemic, when it spiked last year, was mostly temporary unemployment, people who either believed or were told they would get called back. So they were never actually really searching in the labor market the way people who were permanently laid off were. Now that's getting a bit back to normal. There are people who are not working, people who are waiting to look, but not as big a spike as those headline numbers suggested.
Jed, I look at your work and I fold it into what the esteemed Jared Bernstein does now at the White House with President Biden on the social aspects of our American economy. You basically invented this at truly a long and go. Tell us about your two Americas right now. I look at the Indeed website and it's a bunch of happy people, work from home, they're innovating and all this other stuff. And we know there's an America out there that's not participating. How wide is that divide?
There are big gaps. Working from home is for the fortunate. People who have a college degree, more than a third of them have been working from home, even now during the pandemic. For people with a high school degree or less, it's well under 10%. So big differences. You can see this by education. You can see this by race and ethnicity. One big concern coming out of the pandemic is the way that the labor market may shift permanently could be to eliminate some lower wage jobs even more. The government a few weeks ago put out some updated projections, long-term projections, about which occupations will make up the economy over the next 10 years. And the long-term biggest hit could come to many of the jobs that require only a high school degree or even less. So we could see even more polarization in the labor market as the result of jobs in some sectors being permanently lost.
Which unemployment rate do you use? I mean, from a social aspect, the U3, the traditional unemployment rate, doesn't get it done, does it?
I do tend to look more broadly at a set of other measures. I mentioned the core unemployment rate that takes out temporary unemployment, especially useful in this pandemic where temporary unemployment spiked. The U6 rate, that also takes into account who's working part-time but wants full-time work. Best of all might be the prime age employment population ratio. That's the one that looks at everyone 25 to 54, the share of them who are employed. What that does is that accounts for people who might have dropped out of the labor force, have given up looking for work, but still could be coaxed back in if they felt safe, if wages were high enough, and if conditions were right.
Jed Coco, thank you so much. That was terrific and really an important conversation at a time when there's so much uncertainty. Tom, I gotta say, it's important to be having this conversation as we talk about a world flush with cash. We still have this high unemployment rate relative to history, and we also have real labor market shortages, these frictions potentially slowing down a recovery that otherwise would be full steam ahead.
Lisa, we didn't have time to get to Jed Coco on the San Francisco market. I know you've been looking at that thing in Pacific Heights for 16.5 million, but you wonder with all the gloom about San Francisco, yet the tech boom that we're still in, just the metrics of real estate in the country, you wonder what it says about Coco's two Americas.
Yeah, well, there is a question about big urban centers and how much they're going to come back. And I will say, I've been asking you to liquidate some of your Bitcoin holdings, your BitDog holdings, so that I can go and make lots of profligate purchases around the country. There is a question, though, right now, especially as we look forward to two Americas, how quickly we can get people spending and borrowing and doing the American thing again if you don't have a labor market that has increased dramatically.
I said on Fifth Avenue last night, Lisa, and granted, it's a pretty Tony part of America, but it was new car after new car after new car, and we just see near 18 million units in March as part of that retail boom.
Yeah, well, and we've been talking a lot about how the cities that we've seen have been coming back in a big way. And yet, to your point about San Francisco, Deutsche Bank put out a report yesterday saying that that office space demand might decline 10 to 40% over the upcoming years.
Well, it is an eventful day to say the least. At this moment, the Secretary of State speaking on new action by the Biden administration against Putin and Russia. This is a complex topic. We'll have much more on it through the day. As well, on banking, Brian Moynihan of the Bank of America later. This is Bloomberg. Good morning.
With Afghanistan will continue. Our security partnership will endure. There's
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
It's the boom you've been waiting for. From New York City for our audience worldwide. Good morning, good morning. The countdown to the open starts right now. With 30 minutes until the opening bell, equity futures are positive 0.6% on the S&P 500. We begin with the big issue, a booming American economy.
We've had the speediest recovery ever.
The economy has come roaring out of the gate.
Most importantly, the economy is starting to open.
You're going to see the data pick up very rapidly over the coming months.
The bar has been set high for US data.
Expectations are pretty high.
Very lofty, mature expectations baked in.
The potential for another boom in the economic data.
The second quarter is a turning point.
There's a lot of cash sitting around.
Investors are looking at that and they're seeing opportunity.
The data prints are going to be so eye-popping.
This is now really the point at which the strong growth outlook becomes fact rather than forecast.
That line from Luke Cower, lofty expectations baked in. We'll return to that in just a moment. Let's bring in the team. Kaylee Lyons and Ira Jersey. Morning, Kaylee.
Good morning, John. Well, more evidence of the boom in the data this morning. U.S. retail sales in March jumping 9.8%, handily beating the average economist expectation of just 5.8% growth. Even when you strip out auto and gas, up 8.2%, again, easily topping estimates. So a lot of strength coming through as stimulus checks hit Americans' bank accounts. And of course, the country continues to reopen. And not the only good news on the data front either this morning, John. Initial jobless claims coming in at a much lower than expected 576,000. Economists were looking for 700,000. That is a 13-month low. Now, of course, it's not just this morning's data that has been surprising to the upside as of late. Over just the last 2 weeks, we've had payrolls, ISM services, manufacturing, CPI, PPI, all of it surprised to the upside. And when you take a look at the Citi U.S. Economic Surprise Index, which measures how much data is beating or missing estimates, it is trending back upwards. Now, one would think that better economic data feeds into the growth and inflation narrative and therefore leads to higher Treasury yields. But as we've seen these beats over the last 10 trading days or so, the 10-year Treasury yield instead has actually come in this morning after that huge blowout on retail sales, better jobless claims. We are sub 1.6% on the 10-year Treasury. Of course, the bond market signaling that a lot of this has already been priced in. The 10-year yield up more than 85 basis points, 95 basis points over the last year. More than 70 basis points of that has come just in 2021. So the market had been anticipating this kind of data. It's just getting it now, John.
Kaylee, let's sit on that story right there. Kaylee Lyons, thank you. Let's bring up the 10-year Treasury yield. On Tuesday, we had better, higher, hotter than expected CPI. Yields were lower on the day by 5 basis points. This morning, retail sales, upside surprise. Yields break lower by 4 basis points to 159.18. Now, in the equity market, you buy the rumor, you sell the news. In the bond market, we've sold the rumor, we're buying the news. Let's bring in Bloomberg's Ira Jersey for more. Ira, your take, please.
Yeah. Well, I think that you're absolutely right, John. Like, this was all anticipated. So when we go back to January and February, and you think about what the Treasury traders and money managers were thinking at the time, was yields were going to be higher this year. There was a question, and still is a question, about how much higher. So a lot of this good data was what was baked into the cake when President Biden became president, and it was clear that he was going to get a big fiscal stimulus. We knew that we were going to get crazy numbers like we've been getting, just because as the economy reopens, we get these good numbers. I think the bond market is telling you two things. One is that there is some growing geopolitical risk, right? We have this risk of what's going on with our relationship with China, which is obviously massive, and today the news out of Russia with growing political risks as well. All of that is weighing a little bit on the market. That's number one. And number two is, this is what was expected. We were expecting to see these crazy kind of numbers. The question I think that a lot of traders are having is, how sustainable will this be in the second half of the year? Will we continue to see 0.5% month-on-month growth in retail sales, or will it dip to 0.2? And if it does dip to 0.2, that does things like push the Fed out even further, and maybe the Fed won't hike until 2024, like they say.
Well,
so there's still a lot of uncertainty, and I think the Treasury
as good as it
market's doing
gets.
that.
So let's pick up on that point. What are the sources of upside surprise for this bond market through the rest of the year?
Yeah, I think some of the big surprises would be if we wound up with, say, retail sales growing at 1% a month for a couple of months. And I do think that ultimately we're going to look past some of these numbers and find out that the economy is on pretty good footing as we reopen, as people get rehired, as wages start to increase. We're going to see a decent recovery, and expectations for 2022 will be decent. So as that occurs, I do think that we'll see 10-year yields eventually above 2%. But for now, we're probably in a trading range where we're going to stay until probably the third quarter when we get more clarity on some of these data.
Ira, good to catch up with you, as always. Ira Jersey reacting to that breaking news over at Bloomberg Intelligence. Bloomberg Economics, Carl Riccadonna, another shout out for him. 9.7% was his estimate. We came in at 9.8. It is an upside surprise for retail sales. I'll recap the breaking news of the last 40 minutes or so. Your median estimate, 5.8%. Your headline number, 9.8%. The control group, a slight downside surprise at 6.9, relative to a median estimate of 7.2. The right kind of downside surprise on claims. Ira mentioned that, 576. Against a median estimate of 700K and a revised previous figure of 769. There were concerns about the direction of travel on claims. Seemed to be the outlier amongst some better data in America. No longer. That comes in to 576. Let's turn now to the bond market. Yields in 4 basis points on a 10-year to 159. At the long end, the bid, we're down almost 5 basis points now on a 30-year to 226. I mentioned this moments ago, in the equity market, it is always a buy the rumor, sell the news kind of story. In the bond market, it's felt like a sell the rumor and buy the news kind of story. At least that's been the story of the week so far. 159 is your yield on a 10-year. Let's bring in Morgan Stanley's Chetan Nair now to get his reaction to this. Chetan, this is the data we've all been anticipating for a while. You for a whole lot longer. You've been talking about this boom with the team at Morgan Stanley for what feels like the best part of 10 months now. Your early take, please, just on the data we've seen, and then we'll move on.
Yeah, Jonathan, I think the data has been continuing to surprise even us on the outside. As you know, we've been well ahead of consensus, and the data now is actually even ahead of our estimates. So this is great news. But I think what we have to also start thinking about is, as a result of the strong growth numbers, what's going to happen to the inflation outlook? And we think that that's probably the one which now we need to focus more on.
Well, let's talk about it a little bit more, Chetan, because I know where you stand on the issue. You think it does persist. You think it persists into 22 and maybe peaks in the middle of 22, and there could be a problem. Can you walk me through how you're thinking about it and why it's different to, say, the crowd, the consensus, the crew over at the FOMC?
Well, I think, John, we're looking at two key variables, which we think could be the factors which will drive the upside risk to inflation. The first is, what is the amount of excess savings stock that the households have built up they're going to spend out? Right now, the general consensus is that the households will not be spending all of that excess savings stock, and therefore they are not worried about a demand push, which is much stronger than what the consensus is thinking about right now. And then the second variable is what happens to NAIRU. What is that level of natural unemployment that is going to bring inflation pressures and wage pressures? And our view is that because you see restructuring in every crisis, you've seen restructuring in this crisis too, you would have seen that NAIRU would have moved higher. And so as the government is trying to take the unemployment much lower, you're going to hit to that level where there's a tug of war between the natural rate of unemployment and the target rate of unemployment which the policymakers are trying to achieve, which will then result into inflation pressures coming in to be much higher than what everybody is prepared for right now.
Chetan, that's an important dynamic, and I just want to pick up on a point you're making. I need some more clarity. How are you getting clarity and transparency on where Naira is when we didn't even know if we got through it in the previous cycle?
So look, John, we looked at the two key components to that. One is what are the permanent job losses that have been coming in through, and that comes in from BLS. And the other variable which we looked at is the movement within industry. And that's a work which is done by Brookings, and it shows that, there is a high hurdle for people to move within sectors. And so when you combine the two factors, what are the permanent job losses because of restructuring, and then see whether they can actually move out to other sectors, that gives us an indication that Naira has moved higher. And look, in the previous cycle, what happened is you gave a very long time for workers and the entrepreneurs to adjust. In this cycle, we are running at a speed which is so fast, you're going to hit to that higher level of Naira much faster. If you, of course, give time to the economy to evolve and workers to learn new skills and get absorbed in the new sector, then the Naira would have been lower. But to the extent to which we are running at this very rapid pace, we are concerned that you will probably be hitting at that point of natural rate of unemployment, which is higher in this cycle.
If you're right, the Fed's got a problem, Chetan, because you think this cycle burns hotter and shorter. How much shorter?
So right now we are saying that, look, the previous cycles have been on an average, last three cycles have been on an average about 8.7 years. The very last cycle was 10 years. We are saying this cycle could be about 4 to 5 years. And that is on the basis of the fact that the Fed just manages to achieve inflation goal, which is, around 2.25%. Inflation is the base case goal for them and for us. But if you overlay the view that I was giving you earlier about the inflation upside risk, if you overshoot goal that the Fed has, i.e. inflation reaches 2.5% and above, because Naira has moved higher, then I think we have a problem. And that would mean that the short cycle is even shorter than 4 to 5 years that we are looking in the base case.
Chetan, I enjoy the commentary, and I'm looking forward to the conversation through the year from you and the team over at Morgan Stanley. Chetan Nair there, the head of economics over at Morgan Stanley, on the latest moves in this economy. Yields are lower by 4 basis points on 10s to 159. On 30s, we're off by 5 basis points to 226. And this equity market's still elevated. With your movers, here's Abby.
Well, John, it's very interesting because, of course, as you were just mentioning, yields are lower, but nonetheless, we have lots of the banks climbing. And that, of course, has to do with more very solid reports for the first quarter. Starting out with this morning's big winner, Citigroup shares are popping sharply higher in the pre-market. The last time I looked, up more than 3%, up about 3% at this point after a top and bottom line, big beats. FIC trading was very strong, coming in at $4.6 billion almost. Equity trading, a big beat as well. And then, of course, from a strategy standpoint, they're exiting 13 markets from a retail standpoint in Asia and Europe. They will focus instead on 4 hubs around wealth management. They are, quote unquote, doubling down. This, of course, is a part of new CEO Jane Fraser's strategy that everybody's been wanting to look at. If we take a look at some of the other results, a little bit smaller moves and actually mixed at this point. Bank of America up 0.6%. They beat a very solid quarter. FIC trading was strong. Their investment banking pipeline is solid, but up 0.6%. U.S. Bancorp and Truist Financial, these stocks had been higher earlier, now down despite beating, although U.S. Bancorp actually missed on sales. So we'll be digging into those results as the day goes on to see what investors don't like at this point. But again, yields probably weighing more on those retail-focused banks, John.
Looking forward to the coverage through the hour. Abby, thank you. Just getting some more commentary from the likes of Carl Riccadonna over at Bloomberg Economics, who was about 10 basis points away from his guesstimate, if I can call it that, Carl, on the retail sales figure that came in at 9.8%. Here's the quote from Carl. The composition of sales, heavily tilted towards discretionary spending like department stores and electronics, shows that the checks that were sent out while providing a critical lifeline for many households released a shopping spree for non-essential items among a significant swath of households. And we can see that in the number, a punchy retail sales report. Though for this program, and for market participants, it's not just about the data, it's how the market responds to it. And there is a bid in this Treasury market today. In the same way that we had a bid post-CPI earlier this week, yields are lower on an upside surprise. We'll talk about that a little bit more through the hour. Coming up, we need to talk about the bank numbers. Bank of America out with numbers a little bit earlier than expected this morning, and Jane Fraser of Citigroup making all the headlines. That conversation up next with Sonali Basak from the Bloomberg team, and Baird's David George from New York. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
You got to put Goldman Sachs at the front of the list. They have won the quarter. But when you look at the universal banks, we've had three of them, JP Morgan, Citi, and Bank of America. And I would say JP Morgan probably came out ahead. But they all have the same trends, John, which is these loan loss reserve releases are very meaningful. They're going to continue throughout the year. And that's going to be the bridge until we get loan growth and higher revenue growth in the second half of the year.
That's the takeaway from RBC's Gerard Cassidy, expecting loan reserves to support the banks throughout a period of tepid loan growth demand. The banks rising ahead of the open following beats on both the top and bottom line by Citigroup and Bank of America. Sonali Basak, a friend and a good reporter here at Bloomberg, has been on top of this, Sonali, over the last couple of days. Goldman wins the quarter. That's the takeaway from the likes of Gerard Cassidy. Who won the morning?
Yeah, Citigroup came out with an astounding news for Jane Fraser's first report as CEO, exiting 13 consumer markets, right? And also beating on almost every front in her first report. What do the numbers look like at the end of the day? They beat on almost every line of business at Citigroup, but they've also, $4.5 billion in fixed income trading revenue, John. That's just behind JP Morgan at $5.8 billion, more than Goldman Sachs. Why is Gerard saying that Goldman has won? In fixed income trading and equities revenue, they have risen more than all of their peers that have reported so far. So that puts the pressure tomorrow on Morgan Stanley to do the same. I did something else for you. I also created a league table when it comes to consumer banking, because we don't see the same pressures there at the investment banks that we do at JP Morgan, Bank of America, Citigroup. But, when it comes down to it at the end of the day, it's actually Wells Fargo that was able to hold their consumer banking operations flat at $8.6 billion in revenue. Citigroup did have the biggest decline in that business despite beating on their top and bottom line expectations.
Got to say, that was unexpected. Sonali, just a final word from you on Jane Fraser over at Citigroup. It's a change away from Corbat. How big a change are you expecting for the years ahead from the people you discussed this conversation with right now?
it's interesting. This consumer business has been plagued for years, right? So it's hard to say that this kind of change wasn't expected to some degree. What's surprising is right out of the gate, she's telling you that she's going to impact a business that generates about $4 billion in revenue. It's significant. Analysts are already saying it should free up capital for the business, and it should start to help Citigroup focus its expenses on places where it can make more money and win business.
Market likes it, up 2.5%. Shonali, we'll touch base with you a little bit later this morning. Ahead of the open, that stock is higher. Let's bring in Baird analyst David George. Joins us now, has an outperform rating on Bank of America and a price target of $38. Great to catch up with you, David, as always. Your early take, we've got the numbers from a whole host of banks in the last 24 hours. Gerard Cassidy likes what he saw from Goldman. Do you like what you see this morning, David?
Yeah, banks have given us, Jonathan, pretty much everything that you could hope for. Good capital markets, loan loss reserves are continuing to come down, as you mentioned, and deposit growth continues to be very good. Really, the missing link here is just is loan growth, and when does that start to get better? But all in all, a very good showing so far from all the banks that have reported.
Well, David, let's try and make it simple. What's distorting the picture here for these particular banks that haven't been able to leverage this booming economy yet, at least in the first quarter? And whether that dynamic persists through the next quarter and into the back half of this year?
Well, it's definitely going to take some time for all of this liquidity. Just as an example, Bank of America took in over $300 billion in deposits just over the last year. So for those that are expecting a ton of loan growth over the near term, I just think that that's unrealistic. And all of that liquidity, we think at least, needs to be deployed prior to expecting a big surge in loan demand. So that obviously from here, we think loan growth and higher rates are really going to be the key for the banks to sustain the rally that we've experienced so far in 2021.
The consumer side of the business has got a lot of attention over the last 24 hours because of this loan issue. Can we talk about the investment bank at several of these banks at the moment, David? We often talk about trading and trading revenue as if it's just about the weather, the climate. But a lot of this was down to execution too. The likes of Goldman Sachs being one of the banks that stands out. What stood out for you, David?
Well, it's really been just unbelievable just thinking about where we are today relative to where we were a year ago in the capital markets. We've gone from panic to euphoria. The SPAC market and the equity issuance has really been off the charts so far this year. And as you mentioned, there's been numerous beneficiaries from Goldman, B of A, JP Morgan, really across the board. And really the question now is, what's the sustainability of the current run rate in capital markets? And obviously it's early in April, but we expect things to normalize a bit, Jonathan, as we move through the balance of the year in that market-sensitive segment.
So to conclude, it introduces the question, David, that I finished with Gerard Cassidy, your peer, in the last 24 hours too. With all of that in mind, the consumer business, the investment bank, for the back half of this year, what kind of business model in the banking world do I want to own as an investor?
All else equal, from our perspective, is banks that are really levered to an improving economy, and that really is all of the major banks. But I think the real leverage is going to come from higher rates, more loan demand, and hopefully a Fed that starts to get a little tighter. That's really the key for banks to experience notable earnings improvement from here is a less dovish Fed, higher rates, and more loan demand.
Outperform rating, $38 price target on B of A, David. Is 38 an outperform rating still for you? Was certainly at the start of the year, given where we were.
Yeah, we upgraded B of A at $20 a little over a year ago. So it's obviously had a very big move, and it's hard to keep up with the various targets and so forth. But that's certainly something that we'll be looking at. I can't really tell you what we're going to do with our target and rating, but that's obviously something that we address every day.
I never expect anyone to do that live on air, David, but one day I'm sure someone will. David George, it's good to catch up, sir. As always, thanks for your time. Thank you. Joining us from Baird, the hope that rates go higher, maybe. For the banks, for the bank bulls at least. Look at where rates are right now. Yields in 4 basis points on 10s, on 30s down 5 basis points. Even with better inflation data, I say better, let me choose my words a little bit more precisely. Higher than expected inflation data earlier this week. Yields were lower on the day, on a session on Tuesday. Again, retail sales coming in punchy. Yields are lower, down 4 basis points. And here's the issue for me right now, and I'm having that conversation with Julian Emmanuel of BTIG at the moment on the Bloomberg, and I'm going to catch up with him in about 10 minutes on this program. What economists expect versus what markets are positioned for can be two completely different things. And we need to discuss that in the following segment. Before we get there, I'm going to bring you some analyst action, some morning calls, and then later, soaring valuations, record earnings, raising concerns over peak expectations. That conversation still ahead with Julian Emmanuel of BTIG and Jana Barton of Eden Vance. Looking forward to that chat in about 7 minutes. Going into the opening bell, this is how we're set up. Equity futures look like this, up 22 on the S&P 500. We advance 0.5%. From New York City this morning, good morning. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Five minutes away from the opening bell in New York City this Thursday morning. Good morning to you all. 4140 on the S&P 500. Futures bid higher by 22 points. We head north. We move higher by 0.5% on the S&P 500. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, the team at Barclays, upgrading UPS to equal weight, 180 price target. The analyst citing momentum in parcel markets and the stock's relative valuation. Your second call from BTIG, initiating coverage on Coinbase with a buy and $500 price target. Analyst Mark Palmer seeing potential for immense upside with the global adoption of Bitcoin increasing. That stock is higher by 4% in early trading. And your final call from the team at Goldman, upgrading Hershey's to a buy, 181 price target. The analyst expecting fundamental improvements to fuel a multi-year period of stock outperformance. We're up there by 1.64%. Coming up, soaring valuations, record earnings, raising concerns about peak expectations. That conversation coming up next with BTIG's Julian Emmanuel and Jana Barton of Eden Vance. From New York this Thursday, going into the open 4 minutes away. Futures looking good. This is Bloomberg.
we're early on in this year. I know we've already sort of penciled in 6 or 7% growth and a big fall in unemployment, but under outcome-based policy, we really want to